our near-term outlook on equities isn't great.
Some of those valuations seem much more ephemeral and .com-like.
Overall market's really not that expensive once you take out the Mag 7.
A key word for investors now and always is diversification.
It's really about long-term investing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday with big tech back at all-time highs. A record share of fund managers say U.S. stocks are overvalued. Just one day before a trade truce between the U.S. and China expires, Nvidia and AMD agreeing to pay the U.S. government 15% of their revenue from Chinese chip sales.
This is highly unprecedented, Jonathan. Basically, the U.S. government is taking a piece of corporate America's pie when it comes to these two chip makers, NVIDIA and AMD. And what makes it so complicated, even from people that served in Trump's first administration as National Security Counsel, these chips that they're going to be taking 15% from are the MI308 on AMD and the H20s from NVIDIA. And these chips had export controls on them in April, because the Trump administration said they were aiding the Chinese military. Now, these companies are getting the export licenses if and because they're giving 15% back to the U.S. government.
So let's pick up on those two words, national security. Are we putting a price on national security, or do you think the rationale of national security was misleading to begin with?
I think it remains to be seen. And it depends on the pattern of what we see in this administration, though. The fact that you see tariffs go into effect, and the president says maybe we can have less tariffs if you invest in the United States. Now they're basically saying, okay, we're going to unwind our export controls. You could send them to China, but we're going to have to take some of that money. And I think in this part, from the Trump administration's thinking, potentially they see killing two birds, one stone. We were able to make some money from this, and we were able to use this as a bargaining chip. Remember, the Treasury Secretary told us a mosaic in the trade talks because they needed those rare earth metals.
So we're all waking up this morning with tons of questions. Here are mine. Is this unique to the chip makers, unique to AMD, to NVIDIA? Or is this a new model for the White House to extend beyond this sector to other companies with a business in China?
Remains to be seen, but likely, why wouldn't we be able to potentially see this again? This is what someone who was a China expert who served under Trump's National Security Council in the first administration told the Financial Times, quote, Beijing must be gloating to see Washington turn export licenses into revenue streams. What's next? Letting Lockheed Martin sell F-35s to China for a 15% commission.
NVIDIA down this morning by about 1%. The broader market doing okay. Equity futures positive by around about 0.1%. Coming up this hour, we'll try and answer some of those questions. We'll catch up with Cameron Dawson of NewEdge Wealth, looking for a choppy August. We'll speak to the former White House trade advisor, Kellyanne Shaw, as the government strikes a deal with chip makers, and Andrew Hollenhorst of Citi calling for the Fed to cut rates at its next 5 meetings. We begin this hour with stocks near record highs ahead of inflation data later this week. Cameron Dawson of NewEdge Wealth writing, there are reasons to expect continued equity chop in August, with risks rising if the market remains overly calm and complacent. Cameron joins us now for more. Cameron, good morning.
Good morning.
Is this a market that's overly calm and complacent?
Well, we certainly have seen signs of very rabid risk-taking. If you think about leadership in the market over the course of the last couple of months has been in very low-quality parts of the market, which means that investors are very willing to take flyers. But if you look at some of the sentiment surveys, they're not all too stretched. AAII is still pretty middling. You are seeing signs that positioning has certainly chased strength higher, so people aren't nearly as underweight. They're more neutral now, which just means that positioning is less of a tailwind as it used to be. But if you look at valuations, if you look at earnings estimates, these are all signs of that people are expecting a lot of optimism. So there's really no downside that's being priced in, but because of positioning, you still could see a chase.
Let's pick out a pocket of optimism, the big bet right now. The big bet's for 2026.
Yeah.
A pickup in 26. What underpins the pickup in 26?
Well, it is fascinating. If you break down the earnings estimates between revenue growth, which is expected to accelerate into 2026, in what I would say is a decelerating nominal GDP growth environment. So that's question number one. Question number two is then you already have about over 100 basis points of margin expansion already baked into 2026 estimates, which suggests that the market is expecting some kind of productivity boom, whether that's just coming from normal blocking and tackling and cost cuts or some kind of AI miracle. So the 2026 numbers at about $300 a share, there's a lot of optimism baked in, but you have the bulls on the street effectively saying those numbers are still too low simply because of things like AI.
When it comes to revenue streams, though, and you think about next year, Goldman Sachs has a note out today saying the tariff impact is yet to be seen when it comes to consumers, when it comes to corporate America. Isn't that a huge risk for next year?
I think that is the big risk and wild card, which is that companies have been very hesitant to want to pass on tariff increases to consumers thus far. You've seen pockets of it, but companies are worried that if they raise prices, that they will lose market share, meaning that prices go up, quantity goes down. So we haven't seen this full pass-through of inflation to consumers. Companies have been absorbing it more, taking it more on a hit to margins. So as we see these tariff rates get set in stone, as the uncertainty about where they land starts to fade away, we would expect companies to pass on more of these costs to consumers. And thus, you could see that revenue number be more of a challenge because it means you're giving up on quantity.
So then my question is, why is everyone so bullish for 2026?
Because 2026 isn't here yet, and you have this huge liquidity tide that is continuing to support markets. I think it's important to remember that oftentimes we try to ascribe narrative to price action, and that the price action can be driven by things that are not related to what's going on with the narrative or earnings growth. So as we're seeing the market drift higher because of things like liquidity, because of things like positioning, we look around and say it must be because earnings are so fantastic, when in reality it could be those other drivers.
Remember payrolls? Feels like a lifetime ago. More data this week, CPI tomorrow, retail sales later this week. What are you and the team looking for from this week's data?
Yeah, the question will be is how saucy could inflation prints have to be that it challenges the 80% or almost 90% expectations for a rate cut in September? And really the inflation is going to be under the surface that we're looking for. The headline numbers may still be fairly stable and benign, but it's looking in the durable goods line where you're expecting to see that inflation pass through. So the question will be is, are you seeing enough of an inflation pass through that it backs the Fed into a corner where they're having to choose between a weaker labor market versus higher inflation? And we've been calling this environment stagflation light, which is just you're getting a deceleration in growth with sticky inflation. That's something that this current Fed, and that's an important point, this current Fed won't like. The future Fed may not be as much of a problem to deliver cuts.
The dual mandate is in conflict already. Before we get to the future Fed, let's focus with the one we've got. Do you sense they're going to prioritise one half of the mandate over the other by the time we get to September?
Well, they certainly seem to be, members of the Fed are leaning that way, saying that we have the ability to look through the inflation that's driven by tariffs. Even Powell said that at the last press conference. We do expect these inflation dynamics from tariffs to be temporary. So it means that if the labor market continues to show signs of deterioration, even if you see some tariff impacts in the CPI line underneath the surface, they could still deliver the cuts.
Michelle Bowman over the weekend was talking about now she wants 3 cuts before the end of the year. How many cuts do you think the Fed will actually come to fruition?
Well, we've been in this camp that we think that the Fed is going to deliver all or nothing at all, which means that if the labor market remains resilient, which we got data that suggested that that's not the case, that they wouldn't cut at all, but that if the labor market deteriorates, then they start to make a path and a march towards neutral. And so it's very possible that you could see 3 cuts this year simply as they are moving in that direction towards a neutral rate, which we know is, the Fed thinks it's over 100 basis points lower from where it is here.
But we have 2 more CPIs, 1 more jobs print before the Fed meets. What are you putting more weight on?
So we do think that the labor market data isn't necessarily weak enough that they have to step in and do a big 50 basis points cut. But we do think that the inflation data could mean that they have to balance this dual mandate. So it just means that maybe they cut and move slightly towards neutral, but they don't deliver the deep degree of cuts that many bulls are expecting.
That's the data this week. Let's finish on 2 single names. I know you can't cover these single names directly, but I just want to understand what your reception of this news is, how you're receiving it on AMD, on NVIDIA, to basically turn around to an American company and say, if you want to play, you've got to pay. Give us our cut.
Yeah, if we go back to April, we were debating what role these tariffs played. Were they simply just a revenue-raising mechanism, or were they actually intending to rebalance global trade and accomplish some geopolitical types of aims? It seems more and more that this is just a true pursuit of revenue. That means that they stick around. That means that they get baked into budget forecasts. It means that the rate that we have today should be seen as a floor, not a ceiling.
I don't know what this means for equities, but does that make it bullish for bonds?
In theory, yes, because it means that if you're continuously raising revenue, even though you can't put it in the budget statistics, you don't have to issue as many treasuries because you have this external revenue service slush fund in order to pay your bills.
Bond yields lower this morning on a 10-year, down by about 2 basis points. The 10-year 4.26 on 30s this morning, down to about 4.83.
What feels highly unusual about the setup of this, and so far we don't know yet, the Trump administration hasn't said what they're going to use these funds for, where it's actually going to go to. The administration has tried to use this carrot and stick approach with companies and countries to invest in the United States, build a plant, manufacture, please come make this your home. This is outright saying what you said. If you want to play, if you want to do business outside of the U.S., well, you're just going to have to give us a cut.
Cameron, it's good to see you, as always. Thanks for dropping by. Cameron Dawson there of NewEdge Wealth. If you are just joining us, welcome to the programme. Big inflation print coming up later on this week, going into that very close to all-time highs on the S&P. Equity futures so far this morning pushing just a little bit higher. With an update on stories elsewhere this morning with your Bloomberg brief, let's cross over to Yahara Anand. Hey, Yahara.
Good morning, John. Shares of Nvidia and AMD are trading lower in the pre-market after the chip makers cut an unprecedented deal to pay 15% of their China AI chip sales to the U.S. government. The agreement will allow them to export licenses to the country and reflects President Trump's effort to engineer a financial payout for America in return for concessions on trade. Meanwhile, the U.S. expects to complete trade negotiations with countries that have yet to secure a trade deal by the end of October. That's according to Nikkei Asia, citing an interview with Treasury Secretary Scott Bessent. He also reaffirmed the importance of the Fed's independence, but said that the next central bank head should be very attuned to forward thinking. And President Trump is preparing to meet with Russian President Vladimir Putin in Alaska on Friday to discuss ending the war in Ukraine. President Vladimir Zelensky said Kyiv won't cede territory to end the war with Russia. European leaders pledged their continued support for Ukraine's sovereignty, saying international borders must not be changed by force. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the programme, pay to play.
The H20 was the third best chip in the world. The president has decided that the Chinese can buy them, but that's in a balanced way with the Chinese delivering on the deal that we made with them.
Up next, we'll catch up with Bloomberg's Tom McKenzie, live from New York City this morning. Good morning. Live from New York City, welcome to the programme. Here's your week ahead. It starts with inflation. Tomorrow morning, US CPI just around the corner, 8:30 Eastern Time. More data through the week. On Thursday, PPI and jobless claims. On Friday, look out for retail sales. And then in the middle of all of this, not really been talked about so far this morning, or over the last week for that matter, the trade truce between the US and China expires in the next 24 hours. Now, most people assume there will be an extension of this truce by another 90 days, but we haven't seen that extension just yet.
When it comes to the London talks, Secretary Bessent said when it comes to the final decision, that'll be left for Trump. Trump hasn't said that yet. What did he do overnight, though? He started truthing about China buying more soybeans on the basically right before this deal is set to expire and we go into harvest season in the United States. What my understanding from this administration, from the Treasury Secretary, is that there's likely going to be another 90-day extension. But to your point, we don't have it just yet.
Look out for that in the next 24 hours. For the broader equity market, coming into Monday, close to all-time highs and adding some weight to the rally. Equity futures up by another 1/10%. We have seen it on repeat over the last week. Upgrades to the outlook for the S&P 500 price target at Capital Economics, at HSBC, at Citi on Friday going into the weekend. What's on earnings? Better than expected earnings in America. Even with all the trade friction continuing, the earnings story has been pretty powerful. That's why you see the Nasdaq coming into Monday at record highs. That's the equity market. Under surveillance this morning, it's pay to play.
The H20 was the third best chip in the world, and now it's the fourth best. The president has decided that if things are going well with China, that they can buy them. So I think that decision's been made. We are putting on the licensing mechanism, and we are getting that going. But the president has decided that the Chinese can buy them. But that's in a balanced way with the Chinese delivering on the deal that we made with them, and they're delivering rare earths.
So here's the latest this morning. Sources telling us here at Bloomberg that Nvidia and AMD have agreed to pay the US government 15% of their revenues from chip sales in China in order to secure export licenses. Joining us now is Bloomberg's Tom McKenzie. Tom, welcome back to the show, buddy. Let's just talk about how this is going to work. How is this going to work?
15% of sales, 15% of the revenues that they make from those sales into the China market of the H20 when it comes to Nvidia or AMD's equivalent. Once they start shipping those, they will get the export license. According to this reporting, if they pay that 15% into the US Treasury. That apparently is how it's going to work. There are legal questions around this. If this is categorized as an export tax, potentially there are legal challenges to this. But according to our reporting, this is what Nvidia and AMD have signed up for. And again, quoting some of the analysts in our own reporting, pretty unprecedented. Hard to think of another example of a US corporate signing up to this kind of export demand from the US government. China, meanwhile, yet to officially comment, John, on this development, but they have in recent days pointed out through state media and through blogs affiliated with state media concerns about what they describe as national security risks associated with Nvidia's H20 at a time, of course, when China is now showing no signs at all of walking back from its doubling down on building out its own chip sector and ensuring that it has less dependency on those US AI accelerators.
Tom, you've spent years in China. What do you think they're thinking behind the scenes in terms of the US going to corporate America and saying, you can send these chips to China that we originally blocked because of national security concerns, we just want a piece of the pie?
I think if you rewind the clock 6 months, China is in a much better position versus now. The H20s, the licenses, it seems, will be approved for those. You look at the movements in terms of the equity markets for China. Yes, they have all the concerns about the domestic consumer and about the real estate and property sector. Those remain. The geopolitical tensions, you talked about the fact that this truce is expected to be extended again by 90 days. China continues to invest. You see the developments coming through from the likes of Huawei at 7 nanometers and Xpeng, according to reports, coming through with a chip of 5 nanometers, not closing in on 3 nanometers that the likes of TSMC are churning out, but closing that gap. So they're going to get access to the H20, but continue to build out their own AI accelerator capacity and try and close that gap. I think China will probably be rubbing its hands at the prospects of potential domestic pushback on this policy as they continue again to try and funnel investments into AI accelerators that they continue to need that underpin the models, of course, of Alibaba, DeepSeek and others. And it's really high silicon that sits at the heart of Huawei that is leading the charge on this front.
Tom, are you basically saying that China needs the MI308 from AMD and the H20 from Nvidia just to bridge to basically when they're up to par where the United States is in terms of these advanced AI semiconductors?
China has not spelt out, Annmarie, its policy around this, but it is pretty clear that a reliance on US chips is not what China is going to be comfortable with. And the fact that Jensen Huang has essentially said, look to the US and to President Trump, we should be allowed to continue to supply these AI accelerators into the Chinese market, precisely because if it comes to it, we could just pull the plug on those. That gets picked up by China. They're listening to that. So yes, this can tie them over until they have their own capacity. There's the other question about national security. The case being made by the Biden administration and by the Trump administration to allies in the Netherlands and in Japan, do not sell your hardware and software into the Chinese market because of national security concerns. Well, that now has put a big question mark over it, because if you're prepared to pay that 15%, then suddenly national security concerns seem to be being put on the back burner.
Hey, Tom, well framed as always. Tom McKenzie out in London this morning. Tom, thank you. To build on the conversation, Terry Haines of Pangaea Policy joins us now for more. Terry, good morning, sir, and welcome to the programme. Did we just put a price on national security, or was there never a national security risk to begin with?
Good morning, John. And I think I'll take the third door, frankly. Of all the options which you and Annmarie have laid out very well this morning, I think the one I find most compelling, or more compelling, is that this was part of the U.S.-China negotiations to begin with, and that's the principal reason why this chip's being let out the door. I'll defer to Secretary Lutnick on whether it's the third best chip or the fourth best chip or whatever, but the the fact of the negotiations are really the big deal here, and Bessent's been very upfront about that.
Right. He called it a mosaic in the trade talks, using the chip in the talks as a negotiating tool. But Terry, what about the fact that the U.S. government is now saying you can send those chips over if we get 15%? How is this capitalism and not central planning?
Well, I'm not going to be an apologist for the Trump people, and they have some explaining to do on that front, I think. But I think it's probably a mistake to read this as some kind of a bigger pattern, generally speaking. I think what my instinct on this is that what they did was the final bit of this was to say, well, let's see how desperate they are to actually want to export. Let's see if they'll pay something as the final piece of the puzzle, and they did. But you got the tech industry being humbled on both ends here. On the one hand, the pieces being taken out of them out the door on these chips, and on the other end, China says they want the chips, and now apparently they might not want the chips because there's an unacceptable backdoor, or they want these companies to parse through the chip to show them that there's not a backdoor. They're therefore showing you where the backdoor would be, that sort of thing. So either way, this isn't exactly the cruise the tech industry signed up for either. So I think they're probably going to be warier of any deal next time.
But Terry, if Trump can get away with this, why wouldn't he do this with other companies and key security products, even things like LNG to Europe?
I'm not saying he would or he wouldn't. All I'm saying is that I think this is the first of a special circumstance, and I wouldn't expect the administration to extrapolate that. And one reason why, frankly, is it makes the ability to export less attractive. So. I think in the vast majority of cases, this is not a tool the administration is going to be interested in using in any sense. I don't think we're going full mercantilist here.
Speaking of China, tomorrow the détente between Beijing and Washington is set to end. Do you think we get an extension? And for how many extensions can these two countries go through?
Well, I do, but the reason why doesn't really have anything directly to do with China. It has everything to do with China's client state, Russia. One reason why the United States is playing footsie with China, technical trade term we all know, is that they want to get China to get Russia to stop the war in Ukraine. The way not to do that is to pile a bunch of tariffs on China this week. So the reason, fundamentally, I think the extension continues. And from there, success or failure of the Russian talks will proceed. But and what I said to markets yesterday was, you look at the Russia talks as a canary on the China talks. If they go directionally well, the Russia talks, that means China's playing with the idea, at least, that it's time to wind up the Russian-Ukraine business. But if not, then not. So I think you're going to see directionally how one goes based on the other.
Terry, appreciate it. Thank you, sir. Terry Haines there of Pangaea Policy out of Washington this morning. It's all one big piece of the broader negotiation.
Potentially, and Terry basically pointing to the fact that maybe Beijing is putting the thumb on Moscow now to wind down this war. It is interesting reading some of the tea leaves. Xi Jinping got on a call with Putin on Friday, and in the press readouts in China, there was this idea that they look forward to these discussions between Putin and Trump and would like to see working towards a peaceful resolution.
Are you expecting a resolution this weekend?
No, I think the best case scenario is that you get a process to a resolution. So there needs to be a process put in place to really get to the fundamental issues, a lot of national security issues when it comes to Kyiv and Moscow.
That meeting taking place near the end of this week. Up next on the programme, coming up, we'll catch up with the former senior White House trade advisor Kellyanne Shaw on the latest movement with NVIDIA and AMD. Plus, we'll catch up with Yahara once again with your morning movers, with Coinbase rallying this morning, mirroring a jump in crypto prices. Coinbase up in a pre-market by 4.6%. Equities doing okay this morning, positive by 0.1% on the S&P 500, all-time highs on the Nasdaq 100. Equity markets putting up the best week since June last week, following the worst jobs data since the pandemic. It's not just equities, high-yield credit spreads tighter Monday, Tuesday, Wednesday, Thursday, Friday. Equity market and risk assets are doing okay. In the bond market, 2-year, 10-year and 30-year bond yields are lower this morning. We're down by about a basis point on a 2-year, down by 2 on 10s to 426.16. The next big stop for this market, about 24 hours away, 8:30 tomorrow morning, US CPI. The big data point just around the corner. That's for tomorrow, 3 hours away from the opening bell. Let's get you some morning movers. Let's cross that back over to Yahira. Hey, Yahira.
Hi, John. We start with our top story today. NVIDIA and AMD both falling in the pre-market after they agreed to hand over 15% of their China AI chip revenues to the U.S. government in exchange for those export licenses. Analysts, of course, are calling this unprecedented, especially because there had been a ban imposed for national security reasons, as you and Annmarie were saying earlier. But of course, this aligns closely with the Trump administration playbook of securing financial concessions in return for easing trade restrictions on companies. Next up, we have shares of Coinbase. They are rallying 4.4%, along with other crypto-linked stocks this morning. And this is because Bitcoin is rallying as it gets within striking distance of its all-time high of over $122,000. And what I thought was interesting is that some analysts are saying that some of this buying is in response to the surprise U.S. tariffs on gold bars, which caused chaos in the gold market last week. And we are still waiting on the White House to clarify those tariffs. We may see that today. And we end on Intermex. That is soaring 58% as Western Union announces that it is buying the firm for $500 million as it makes a big push into Latin America with this acquisition. And the reason those shares are rallying so hard is because Western Union will pay $16 a share, which is a premium of over 70% from Intermex's closing price on Friday. John?
Yahira, thank you. Thanks for the update. On our radar this morning, the chip sector in focus, NVIDIA and AMD agreeing to pay 15% of their revenues from Chinese AI chip sales to the US government in a deal to secure export licenses. The move following a White House announcement allowing sales of NVIDIA's H20 chip to the country. Spare a thought for Lip Bhutan, the Intel CEO, visiting the White House later on today. The visit coming after President Trump called for his immediate removal over his ties to Chinese businesses. The Wall Street Journal reporting that Tan hopes to show his commitment to the United States.
So I think when he says his commitment to the United States, likely that'll be what kind of money and investment we are making in the U.S., especially on the heels of this report that NVIDIA and AMD are sending 15% of their revenues when it comes to these high advanced chips to China to the U.S. government. What's one thing is really interesting, the Wall Street Journal reported this on Friday, it's not just the pressure this CEO is getting from the Oval Office. He's in the hot seat as well when it comes to directors and the board about strategy going forward for this company.
Intel's under pressure, NVIDIA and AMD in focus this morning. Let's just talk about those two names. Unprecedented in many ways. We haven't really seen anything like this from this administration or from anyone in the Western universe. I want to talk about where it's coming from. Either you believe there was never a national security risk to begin with, or we just put a price on national security. Now, Terry Haines joined us about 5-10 minutes ago. He selected door number 3, and he said this was always part of a broader negotiation between the US and China. This was always the goal.
Well, here's what I would say. If you look at a letter in June from Matthew Pottinger, who's the president's former deputy national security advisor, he outlines how concerning it would be to the for the United States, for China and China's military to get their hands again on NVIDIA's H20. He says they help China's critical AI ambitions. It means less chips for the United States. It says it will support China's military, and loosening these restrictions weakens export controls generally. The question I have is not just how the United States is going to be using this money, but who is next? Will this now be a strategy going forward this administration will do? Not just carrot and stick approach, with high tariffs going up, we'll lessen the tariff load if you invest in the United States, but instead, if you want to play, you are going to have to give us part of that profit.
We'll come back to this story in just a moment. Just wanted to draw your attention to the bond market. Yields lower at the front end of the curve, down by a basis point or two on a 2-year to about 375. Some Fed speak over the weekend came from Governor Mickey Bowman, calling for 3 rate cuts this year, saying easing policy should prevent further erosion in the labour market. The comments following the latest Fed meeting where both Bowman and, of course, Governor Waller dissented.
So I think you view this as 2 ways. One, she really maybe wants that job and now sees more names being added to the list, like James Bullard over the weekend from the Wall Street Journal. She's thinking, I'm going to double down. I'm not just talking about a rate cut in September. I want 3 rate cuts before the new year. But also, the data right now is in her favor with the weakening labor market. This is why the next 2 CPI prints are going to be so important, Jonathan, after the ISM services really saw potentially stagflation undermining in the economy.
The divide at the Fed, I think, is pretty clear right now, and it's around the dual mandate, full employment, price stability. And which side of that dual mandate are you choosing to prioritise at the moment? So, Governor Bowman over the weekend, we should focus on risk to our employment mandate. 1. Here's another one. The Fed president, Muslim, saying this: we are missing on our inflation target. We are not missing on our employment mandate. And that's going to be the big debate by the time we get to the middle of September.
Absolutely. And what will we see in the economy by September? Goldman Sachs this morning, I was really struck by this note and some of the numbers they put out with it. The fact that they are saying we have yet to see the tariff impact. Right now, they say consumers in the United States have absorbed an estimated 22% of tariff costs through June, but their share will rise to 67% if the latest tariffs follow the pattern of levies in previous years. What does that mean? Potentially higher inflation.
Andrew Hollenhorst of Citi, just moments away, about 10 minutes away, calling for 5 consecutive rate cuts starting in September. Let's turn back to our top story. NVIDIA, AMD agreeing to pay a cut of AI chip sales in China for export licenses. Bloomberg's Wendy Benjaminson joined us now from Washington. Wendy, the team's been on top of this over the weekend and overnight. What have we learned, and how surprised were you by the latest developments?
Well, we were very surprised here in Washington to see this development happen. The idea, as you both have noted, of pay to play, of if you want to sell your chips to China, national security, don't worry about it, just give me 15%. I mean, the Trump is looking for revenue from everywhere he can. That's sort of what's behind the tariff regime, and also his notion of, everything is transactional. So if you want to lower your tariffs, you pay, you do something, you promise to invest in the United States. Tim Cook brought a gold iPhone and some other, tchotchkes to Trump in the White House and suddenly got a break on tariffs. Huang was in the White House the other day and got this deal to sell the NVIDIA chips. So this is just part of the pattern that we've been seeing over and over again. And we will, see it in every aspect of Trump's presidency.
Wendy, do you get the sense that it's unique to these companies, to AMD, to NVIDIA, or is there more to come?
It is at the moment, but there is more to come. As you noted, the Intel CEO is in town today, is meeting at the White House with Donald Trump. So we'll see what comes out of that. And, we have all these other trade negotiations going on, with Canada, with Mexico, with all these countries. Scott Bessent said over the weekend that he hoped all the trade deals would be wrapped up by October. And for that to happen, there's got to be some sort of deal making like this, because in normal situations, as we've said before, trade deals take months, if not years, to work out. But if you want to work them out quickly, give Donald Trump a percentage of your profits.
Wendy, appreciate the update. Bloomberg's Wendy Benjaminson out of Washington, D.C. this morning. To build on this, the former senior White House trade advisor, Kellyanne Shaw, joins us now for more. Kellyanne, welcome. It's something we've explored over the last 40 minutes or so, whether this is a unique case for AMD or NVIDIA, or a brand new playbook that we'll see more of in the not too distant future.
Good morning. Thanks so much for having me back on. Now, of course, what's new about this is not the fact that the administration is allowing sales of H20 chips to China. What's new is this concept of taking 15% of the profits or some amount. We don't know exactly yet what that is or how this will work in terms of operationalizing it. And so it is very unique. This is obviously a president who does not play by the standard rule book. He very much takes approaches that are outside the box and novel. And so looking at export controls in this new way, while it's surprising, I guess the fact that they're doing it this in terms of something novel is not what's surprising.
Kellyanne, have we ever seen anything like this before?
No, I mean, not to our knowledge. This is a very unique approach. I mean, there had been a tremendous amount of consternation and question in Washington about the H-20 export controls in the first place. Were they part of the China deal? Were they national security? Are they being traded away? Like, what does this mean? And so this new element of this 15% of the profits, it's really highlighting how transactional the administration is. And this is a president who's willing to take different approaches to all sorts of problems like trade negotiations, trying to incentivize companies to invest in the United States. And now here he's saying, okay, I'll let you sell your technology to China, but I'm going to take a chunk of your profits for doing so. This is something we've never seen before.
What does this nugget mean in terms of the deal that's set to expire tomorrow?
So we don't totally know, but I will say, having watched the phase one deal play out during Trump 1.0, there's a lot happening behind the scenes. So we had the president tweeting or truth posting overnight about the need for soybeans and China's dependence on soybeans. He's previously talked about aerospace, the fact that China needs our engines and our planes to fly for their military. We are obviously reliant on Chinese rare earth magnets and a number of other critical minerals. And now we have these export controls in the mix. And I think that there is a broader set of issues that was part of that framework negotiated in London that we just don't totally have visibility into. And this may be one of the chits being played behind the scenes. And we now have about 18 hours before those 100% tariffs and higher go back into effect. So clearly there's a lot of horse trading happening behind the scenes right now.
You mentioned the president's truth on soybeans. He said, I hope China will quickly quadruple its soybean orders. This is also a way of substantially reducing China's trade deficit with the USA. You were there for this exact deal. Where are we in terms of that phase one agreement?
Yeah, and this is something that Secretary Bessent talked about going into the Sweden meetings, about whether or not the United States was going to enforce those purchasing commitments that were part of the broader frame or a phase one deal. And he said that they would be talking about it. So clearly this is something that's on the president's mind. Farmers are the tip of the spear when it comes to these U.S.-China relationships. We have a lot of national security concerns, including export controls, but farmers are the ones that tend to get hit first in terms of this retaliation. So the president is definitely putting on the table quite publicly what he sees as something that China can do to sweeten the deal.
Kellyanne, are there enforcement mechanisms that you think we need to rethink this time around that didn't work last time around?
Well, the only enforcement mechanism contemplated under that phase one deal was tariffs. And it was this idea that if China doesn't comply with its both purchasing commitments as well as some of these substantive commitments, that we're just going to tariff them and ratchet those tariff rates back up. Here, what we have is a second prong of enforcement, and that's export controls. And that's new. That's why you have so many China hawks in Washington concerned about the fact that export controls can be loosened and tightened as part of a compliance program versus the pure national security concerns that we're used to seeing export controls be used for. So now the president has two lanes. He can either ratchet up tariffs or he can tighten or loosen export controls.
Kellyanne, appreciate the reaction. The former senior White House trade advisor, Kellyanne Shaw, just 24 hours out from the latest deadline.
And this deadline, it likely seems, and this is what the Treasury Secretary has basically insinuated, it is going to be extended. Potentially, though, this is why you see the truth from the president. He knows that this deadline is tomorrow, and he wants to make sure that China is back in focus. And he's looking for potentially more of a grand bargain kind of agreement. Security concerns like chips, soybeans, all of it on the table.
If you're just joining us, welcome to the programme. Looking ahead to CPI tomorrow morning, 8:30 Eastern Time, Tuesday morning. Before we get to that, a lot to work out in trade in this market too. Equity futures positive by about 0.1%. With an update on stories worldwide with your Bloomberg Brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. As you guys were talking about, President Trump hopes China will quadruple its soybean orders just a day before the trade truce between the two countries expires. The soybean push comes as U.S. farmers are just weeks away from their next harvest. As of late July, U.S. government data showed China has refrained from booking any cargoes for the upcoming season as those trade tensions linger. Meanwhile, Israeli Prime Minister Benjamin Netanyahu is defending his plans to seize Gaza City despite being met with opposition at home and abroad. Netanyahu says it's needed to, quote, complete the job to defeat Hamas and free its hostages. This as the country faces global condemnation over the growing humanitarian crisis in Gaza. And President Trump will hold a news conference today at 10 a.m. Eastern to lay out his ideas for ending violent crime in the nation's capital. Trump says his plan will include moving out homeless people who camp along the city streets. The president's powers, though, are limited by a home rule law passed back in 1973. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, the labour market on thin ice.
I think the labor market are on very thin ice. If you look at the breadth of employment growth, it's basically at stall speed. And, there's also additional weakness in the pipeline.
In just a moment, we'll catch up with Andrew Hollenhorst of Citi, live from New York City. You're watching Bloomberg TV. Equity futures positive by 0.1%, building on last week's gains. On the Nasdaq 100, record highs coming into this trading week, just about unchanged so far this morning. Under surveillance this morning, the labour market on thin ice.
I think the labor market are on very thin ice. If you look at the breadth of employment growth, it's basically at stall speed. And, there's also additional weakness in the pipeline. There's more downside ahead if companies, generally speaking, are a little bit more concerned about their demand outlook. They're not going to be hiring as much or investing as much.
It's the latest this morning. Economic data out this week in focus as Fed Governor Bowman calls for 3 rate cuts this year. Andrew Hollenhorst of Citi expecting even more in 2026, expecting continued softening in labour markets and officials to cut 25 basis points at each of the next 5 meetings. Andrew joins us now for more. Andrew, good morning.
Good morning.
Have we got a labour market on ice? On thin ice?
There's been something very uncomfortable about this labour market for some time, which is that the hiring rate has been very low. So the unemployment rate is low also. That's usually a good sign. But when you look at the demand for workers, it's just soft out there. And you see new workers that are coming into the labor market, new college graduates having trouble getting a job. So I think we've had this weakness that's been there below the surface. It's been in a lot of the details of the data. Now we see it in the headlines.
The split on the FOMC is pretty clear at the moment over at the Federal Reserve. Governor Bowman over the weekend saying we should focus on the risk to the employment mandate. I'm sure you agree. The Fed President Muslim saying this: we're missing on our inflation target. We're not missing on our employment mandate. How do you think they're going to settle this dispute, this debate, in a few weeks' time?
Yeah, I think that's where Muslim and the committee were in July. That's why there wasn't a rate cut in July. I think where they're going to end up being in September, and remember, we have more data, including the CPI report this week, between now and then, but where they'll end up in September is saying that these risks have become more balanced. So you have upside risk to inflation. You're missing on the inflation target, not by a lot. We were 2.5% core inflation in the second quarter, so you're not too far above your inflation target. On the other hand, employment, yes, the unemployment rate is right around levels that would be consistent with full employment, but you have these downside risks. So if you have balanced risks, where should policy rates be? They should be at neutral. And does the committee think they're at neutral? No, they think they're restrictive. So it would make all the sense in the world to cut in September.
When you look at the weakness in hiring, doesn't that match, though, what corporate America has been telling us, which is that basically everything is frozen at the moment because they were still waiting on some actuality of policy from Washington?
Yeah, tariffs may be playing into this, and uncertainty about policy may be playing into this. But it is a trend that we saw emerging even last year with this weak hiring. I think you have seen that increasingly be the case this year. We've seen in the Beige Book where firms are saying they're really not excited about hiring, to your point, and that they've pulled back on these hiring plans. So some of that coming through in the data now.
Well, let's go back to that data point a few Fridays ago. Was that evidence of weaker demand or a supply side phenomenon that's been building over the last several months?
So this is what's so tricky about the labor market data is that we know that supply of workers has slowed down, immigration has slowed down. So you don't know what is the break-even level of payrolls. How much job creation do you need to keep the unemployment rate from moving higher? A point that Chair Powell made, which I think was kind of lost on a lot of people in the press conference a couple weeks ago, is that it's still not great news if you have an unemployment rate that's staying low because you have weak demand, but you also have weak supply. So we do have weakening in supply. We also have weak demand. And I think what we're seeing most recently is that demand side is starting to dominate.
Well, let's pick up on that. OK, there's evidence of weaker demand. Is there evidence of increasing slack, which is the more important feature of this conversation for the FOMC when they get together in the middle of September?
So this is the classic problem of econometrics, is how do you disentangle demand from supply? And one way that you do it is by looking at prices. You look at wages and you say, is there a lot of wage pressure that's building out there? No, wages have slowed. So the fact that wages are slowing are telling you that there's not an issue with lack of supply.
Price pressure in focus tomorrow morning. What are you and the team looking for?
We think we're going to see something more in goods inflation. I think that's the consensus also, that more of that's going to bubble through. We have 0.29% month on month on core CPI. That would round to 0.3. That's where the consensus is. I think even if you get a 0.4, if it's focused on goods inflation, that's not too concerning for Fed officials. What you really don't want to see is this broadening out and becoming a broader inflation.
The White House rejected the labor report and said the data wasn't reliant when we saw the last NFP number. Do you think this is going to be an issue when it comes to CPI?
I don't think we're going to see the same thing talked about for CPI, because you don't have those kinds of revisions to CPI, and really with the jobs report, the
but
focus
it's still
was
the
on those
BLS,
revisions.
and right now there's
it's still
no
the
chief.
BLS. It's still the same statistical agency. Look, at the end of the day, these are the best statistics that we have on the labor market, on inflation. We can talk about whether there should be changes to the methodology or not, ways to improve things. But right now, these are the best numbers we have.
So you trust the numbers. We're going to get them tomorrow. Goldman Sachs put out this. Consumers in the U.S. absorbed 22% of tariffs so far through June. They say that's going to go up to 67% when we have these new rates. How concerning is that? And how much of a pickle and a conundrum does that put the Fed in?
And so it does look like most of the absorption of the tariff costs so far has been by domestic firms and not by the consumer. I wouldn't disagree that more of this is going to bubble up, and we'll probably see more of this in coming months. We really haven't seen anything in apparel yet, for instance, and that could take a couple months before we see that. Optically, it creates some issues because you have some stronger inflation prints, and we might see one of those this week. But again, if you think about the fundamental economics of it, what we should be concerned about is, do we have a persistent uptick in inflation, or does this look more like a one-time rise in the price of certain goods? The broader dynamics in the economy are actually disinflationary. We have a housing sector that's in contraction, house prices that are flat to down, you have wages that have cooled. All of this would tell you that price pressure should be cooling. Yes, we're going to see something more in goods, but I wouldn't be particularly concerned about it.
Do you expect to see the offset coming from services still in the months to come?
I think, if anything, we have downside risk to services inflation, shelter in particular.
Andrew Hollenhorst of Citi. Andrew, appreciate your time. CPI inflation data just about 24 hours away, 8:30 Eastern time, setting the stage for the big debate taking place at the Federal Reserve in September. Before we get there, of course, they've got one more stop in Jackson Hole.
Exactly, and I think Jackson Hole has become so much more important now, because you want to hear where Jay Powell is when it comes to the diverging news, and more individuals lining up with the double dissenters, the likes of Neil Kashkari and others saying, there is concern, Lisa Cook, there is concern when it comes to this labor market.
Every time there's pushback, you know what I hear and what everyone else hears, they're running. They're in the running to become the next Fed chair. Where are we in that race?
Well, in that race, we also had more names added to the list. Former Fed Governor James Bullard is apparently under consideration, according to the Wall Street Journal. It does seem like the Treasury Secretary is taken out. So it's the Kevins, the two Kevins. We do have Myron now joining the board. That's going to help them out. And potentially James Bullard now is a name. And then, of course, Governor Waller. And maybe now Mickey Bowman is trying to push ahead, adding, I actually want 3 rate cuts before the end of the year.
It's a few names in the mix before we get to year end. Coming up next on this programme, in the second hour of Bloomberg Surveillance, we'll catch up with Peter Oppenheimer of Goldman Sachs. We'll speak to Henrietta Treyz of Veda Partners. The former Boston Fed president, Eric Rosengren, will be joining us. Plus, David Rogal of BlackRock. If you're just joining us, welcome. Equities coming into a brand new trading week, very close or at all-time highs on the S&P 500, on the Nasdaq 100, higher once more. On the S&P by a tenth of 1%. From New York, you're watching Bloomberg TV.
What
we do need to be prepared for is more volatility in the data.
There's more downside ahead.
The consumer doesn't feel good right now.
What matters is what's going on in the rest of the inflation basket.
It's a risk, and it can certainly complicate things for the Fed.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now, and your week ahead looks like this. Tomorrow morning, 8:30 Eastern Time, inflation data in focus. Throughout the week, more economic data. Jobless claims on Thursday, retail sales going into the weekend, and in between, squeezed in between, a deadline between the US and China and their current trade truce. For the equity market at the moment, coming into a brand new trading week at all-time highs and adding just a little bit more weight to it this morning, up by 0.1% on the S&P 500, up a similar amount on the Nasdaq 100. On the Nasdaq, two names in focus, Nvidia and AMD in the pre-market. If you want to play in China, you've got to pay.
Exactly. And this is according to a Financial Times report that basically the Trump administration is saying if you want the export licenses to have the H20 or the MI308 from AMD go to China, you're going to have to put 15% of those revenues, give them back to the U.S. government. Now, this is very unprecedented. Everyone we've spoken to has been unable to give us another time and place in history where this has happened. Or as Kellyanne Shaw, who was at the negotiating table with China during the first Trump administration, said it's a unique approach, a diplomatic, constructive way at looking at what we're seeing right now.
Those names down just a little bit. Nvidia down by 0.6%, AMD down by something like 1.7% so far this morning. We keep going back to the same question. Is this unique to those two names? Or are we going to see more of this in the next few months?
We don't know yet, but if the Trump administration is successful when it comes to AMD and Nvidia, what's to say that they won't do this with other names? Why wouldn't they? They have used this carrot and stick approach time and again when it comes to tariffs. High tariff walls. Okay, well, lessen your tariffs if you invest in the United States. We've seen this with a number of companies. Build here, bring your manufacturing, your product here. Now they're saying it different. If you want to play in China, which we have issues with, you're going to have to pay. What I find more complicated for them in Washington, D.C. is going to be the pushback, not just from Democrats, from within their own party, China hawks saying you are putting revenue streams over national security concerns.
Mentioned this deadline between the US and China a few times. Coming up fast, the trade truce set to expire in the next 24 hours. Most people just assume that's going to continue. We'll get an extension of 90 days. I keep wondering why we haven't seen the extension just yet. I remember that extra round of talks between Secretary Bessent and the Chinese delegation. He came out of it and basically said it's up to the president to decide whether we get an extension. Well, here we are. What are we waiting for?
I guess the president or Secretary Bessent was giving the president maximum optionality when it comes to when he wanted to pull the trigger. Maybe there were still some things that needed to be discussed between Beijing and Washington. But when I spoke to the Treasury Secretary before he went to those talks, he said it was likely that we're going to have this 90-day truce have an extension, another 90 days. All of this potentially leading up, in my view, reading some of the tea leaves and reports out of Beijing, a meeting between Trump and Xi Jinping. They've invited him to China, but potentially they can also meet on the sidelines of the APEC summit.
A few signs of fear in this market, both in equities and in credit so far. Record highs, tech-driven rally in the equity market, on the S&P, on the Nasdaq. In high-yield credit, tighter spreads throughout the whole of last week. So following the worst jobs print we've seen going back to the pandemic, every single day after that, Monday through Friday, we had tighter credit spreads. No sign of any fear in this market right now, that's for sure. Coming up this hour, Peter Oppenheimer of Goldman Sachs as stocks kick off a key week nearing all-time highs. Henrietta Treyz of Veda Partners as investors eye the looming trade deadline with China. Plus, we'll catch up with the former Boston Fed President Eric Rosengren with stagflation concerns continue to rise. We begin this hour with stocks near record highs as markets await more clarification on the trade story. Peter Oppenheimer of Goldman Sachs writing it's possible that tariffs could hurt equity prices even if the US agrees on deals with key trading partners. Peter joins us now for more. Peter, welcome to the program, sir. Before we talk about the risk, let's talk about the price. The rally we've seen on both sides of the Atlantic on the S&P and the Euro Stoxx 50 of close to something like 9%. Peter, when you break things down, let's just talk about breadth. Compare and contrast the story in the United States to the story you're witnessing in Europe.
Well, very different story. At one level, it looks very similar. As you said, both markets are rising, but they're rising in different ways. The contributions are quite different. In the US, very much driven, again, by the power of the biggest tech stocks, which are really leading the market. As you say, S&P's at an all-time high. The median stock is around 12% below its 52-week high. So very, very concentrated. Whereas in Europe, actually, there's significant breadth unusual breadth actually in the market, and you're seeing much less concentration. Although of course you are seeing and have seen stocks that are disappointing being very heavily punished, and that's happened on both sides of the Atlantic.
So Peter, let's just pick up on the US tech story and the narrow breadth that I've heard so much about, and I'm sure you have as well, whether it is necessarily unhealthy. If I think about the dominant risks at the moment, they're largely cyclical, they're related to trade, and in many ways some people might look at the US stock market and say that's a source of stability, not necessarily downside risk. Pete, how would you counter that?
Look, I think it's right that, if we step back and think about economies which are still growing, albeit at a slower pace, certainly in the US, but interest rates coming down, that's broadly a supportive environment for risk assets. And the fact that in the US, the tech-heavy largest companies have been dominating the rally is a function of their very powerful continued profit growth. It's not been about speculation. It's really been about very strong fundamentals. And there's nothing wrong with that. The only problem, of course, is that as you get an increasingly concentrated market, it becomes harder to diversify risks, at least domestically. And that's one of the reasons why we've been arguing that investors should take a more open mind view of diversification geographically to improve risk-adjusted returns.
Well, Peter, where is the opportunities in Europe? Because I'm looking at the Bank of America Fund Manager survey out of Europe, and they say European investors, 35% expect stronger European growth over the coming 12 months, but it was 44% last month. So isn't that European story actually starting to dwindle a little bit?
Yeah, and we've seen that to some extent in the relative performance, very much the first part of the year. Europe outperforming both in terms of underlying assets, but also on a dollar-adjusted basis as the dollar weakened. And that difference has moderated to some extent. But I think it is right to say that from a very low base, European growth is improving somewhat. And an important driver of that is the expansion of fiscal policy coming from Germany. And we do also have a couple of other themes that are encouraging interest, particularly increased defence spending, which is powering ahead, more infrastructure spending across Europe, and also some of the value areas of the market which are doing really very well, banks being a perfect example. And I would say that is another difference between Europe and the US. The US is still being driven by growth-dominated themes, particularly related to technology, whereas in Europe and some other markets, value is actually outperforming.
The risk of tariffs, though, still exists, and the team at Goldman Sachs had a note out about how the impact has yet to hit. Consumer prices, when it comes to tariffs, that hit is just getting started. What could this mean for Europe and some European corporate names?
Well, I think that it does complicate the picture because we haven't yet seen the full effect of tariffs on either side of the Atlantic, and it is likely to weigh on consumer confidence to some extent and the ability for consumers to continue to drive economic growth. And we're already seeing some evidence of that slowing, particularly in the US, and alongside it, some weakness in the labour market. The offset, I think, is that you will see lower rates, at least in the US. We think for the ECB, they're done for now. They've already cut rates more aggressively. And I think there's less room for that to continue. Given that we're going to see some effect of tariffs still yet to come through.
Peter, you mentioned the rally we've seen in US tech, validated by the earnings. The earnings have been really powerful. I believe you said the same thing. For the banks and the run-up we've seen in Europe, this rally of more than 40% for European banks so far year to date, has it been justified also by the earnings you've seen so far and the outlook coming from the C-suite?
Yeah, very much so. And we have to emphasise that this is a huge turnaround from the trend that we saw really for a decade after the financial crisis, where banks came under huge pressure, particularly in Europe. They had to delever, raise capital, cut dividends, and although they were cheap in terms of multiple, they kept on underperforming. But we've seen a dramatic change in circumstances. Now they have strong balance sheets. You mentioned earlier that the credit cycle is benign, and more confidence in the economy means less risk of loan losses and credit losses and provisionings for the banks. And we have steeper yield curves, which are very supportive of their profits. So in Europe, the very powerful returns that we've been seeing in banks is justified by very strong fundamentals, just as the technology companies have been supported by fundamentals in the US.
Can we just touch on the rates backdrop for Europe? For a long, long time, they complained about negative interest rates. We got away from that. Now it feels like rates are starting to come back down again, Peter, and maybe they don't stop at 2. Perhaps they don't stop at 1. How important is the rate outlook for the long story on banks?
I think the most critical factor is going to be growth. If we avoid recession, that would be our central view, then the risk of a provisioning cycle that could be damaging for earnings is moderated. Of course, what's been very helpful for the banks, and this has been true in many regions, particularly in Europe, is that yield curves have steepened. We've seen already a lot of progress on short rate cutting by the ECB, but long rates have been edging up, partly driven by growing deficits and spending, particularly in Germany. And that spread has been very helpful for banks. It may moderate a little bit moving forwards, but I think if we continue to get economic growth, the outlook is still reasonably benign for the banking sector in Europe.
Peter Oppenheimer of Goldman Sachs. Peter, appreciate your time. As always, the difference between the US and Europe right now. Annmarie keeps going back to this story from Jan Hatzius and Goldman Sachs, the investment bank here stateside, and what's going to happen with tariffs. And ultimately, who's going to pay the costs? Who's going to have to carry some of this? This from Goldman. Consumers in the US have absorbed an estimated 22% of tariff costs through June. That share, according to Hatzius and the team, will rise to 67%. American businesses have eaten a lot of this so far, taken around 64% of the hit from tariffs. They believe that share is going to fall to less than 10% in the months to come. So this story's not over. Watch this space.
It's certainly not over, and this is why the Fed is in this conundrum, and this is why individuals are concerned that potentially what you could see is, or as Cameron Dawson talked about it, stagflationary light environment. And this is going to be really challenging for the Fed. They think they have a weakening labor market, but say we get hotter CPI prints, what do you do with that kind of data to make sure that you have your dual mandate basically working against each other?
It might be a story for later on in Q3 going into Q4. Equity futures this morning positive by about 1/10% on the S&P, with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. We start with our top story. Shares of NVIDIA and AMD are trading lower in the pre-market after the chip makers cut an unprecedented deal to pay 15% of their China AI chip sales to the U.S. government. The agreement will allow them to export licenses to the country and reflects President Trump's effort to engineer a financial payout for America in return for concessions on trade. Meanwhile, the price of lithium is spiking this morning. The surge comes after battery giant Contemporary Amperex Technology halted operations at a major mine in China. That's spurring speculation that Beijing might move to suspend other projects as it tackles overcapacity across its economy. And AMC shares are surging 5.5% in the pre-market after the entertainment company reported second quarter results that beat estimates. Revenue for the quarter came in at 36% higher than the same period last year, showing strong consumer enthusiasm for this year's lineup of movies. Movie theater attendance also rose 26% compared to last year at just under 63 million people. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next, quid pro quo in China.
The H20 was the third best chip in the world. The president has decided that the Chinese can buy them, but that's in a balanced way, with the Chinese delivering on the deal that we made with them.
In just a few minutes, we'll get the view from Washington, D.C. We'll catch up with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. Stocks are positive, up by 0.1% on the S&P, up by 0.1% on the Nasdaq 100. Under surveillance this morning, quid pro quo in China.
The H20 was the third best chip in the world, and now it's the fourth best. The president has decided that if things are going well with China, that they can buy them. So I think that decision's been made. We are putting on the licensing mechanism, and we are getting that going. But the president has decided that the Chinese can buy them, but that's in a balanced way, with the Chinese delivering on the deal that we made with them, and they're delivering rare earths.
Well, here's the latest this morning. Sources telling us here at Bloomberg that Nvidia and AMD have agreed to pay the US government 15% of their revenues from AI chip sales in China in order to secure export licenses. Bloomberg's Wendy Benjaminson joined us now for the latest in Washington, D.C. Wendy, welcome back. And just to go back to the top of the story once again, I think we keep exploring the same theme. Whether ultimately we've just put a price on national security, or whether for this topic, and this topic specifically, maybe the national security rationale was misleading to begin with.
It's entirely possible. We do know that Trump runs a sort of pay-for-play operation, and as the Commerce Secretary just said in that clip, that the administration has decided that China can buy those chips, but that comes at a 15% cost to NVIDIA and AMD. So it's unprecedented as far as we can tell so far. Transaction. I mean, I certainly don't remember anything like this in, many years, and I'm sure you don't either. And it's just part of this. If you are nice to me, I will give you a job in the administration. If you are, loyal to me, I will endorse your campaign. If you pay me 15%, you can sell your chips in China. It's all part of, it's all part and parcel of the approach this administration takes.
I'm not seeing the stocks get hit too hard this morning. Wendy, thank you. Nvidia's down by about 0.6%. AMD a little bit softer. Certainly something we haven't seen before here stateside. Henrietta Treyz of Veda Partners joins us now for more. Henrietta, can you think of another example of something like this playing out in your lifetime?
Certainly not at BIS. Wendy points it out exactly. There's not another example like this. I think the most interesting way to look at this is to see the president sort of expanding out beyond something that was a very real concern for him on Friday. If you followed his Truth Social post, it was very much about these court cases that are pending around the IEEPA tariffs. So if the president is going to be stripped of his authority to impose tariffs via IEEPA, is he giving himself some sort of additional leverage point with export controls and selling them to effectively the basic way of just getting trade flowing and having some sort of card to play with China? I think that's an interesting angle to think about. I think the IEEPA court case story is the most critical here, and the president obviously was focused on that on Friday, and then this announcement makes sense in that context.
Henrietta, if you're in a C-suite of a massive American company and you see what's playing out right now with NVIDIA and AMD, is this a new risk that you need to contend with, that potentially if you want to export your products to outside the United States, you might have to pay the U.S. government?
I think it completely stands to reason. And every single one of these trade deals has some sort of payment component. And what happens is we get these original announcements and then they get materially walked back. So this one's pretty cut and dry, 15%, in the event that that's where it lands. But think about the Japan deal, for example. The White House said that's $550 billion worth of investment that's going to flow to the United States, and we get 90% of the returns. But the reality is that only $11 billion of that $500 billion that Japan committed to is going to come from the Japan bank. Everything else is going to come from private sector that you have no control over. So there are these big numbers floated, and then they're almost always revised. Another example, to give you another one, John, would be the gold tariffs that are happening right now. This, sort of rampant confusion before there's an ultimate clarity is really the prevailing theme of this administration.
Okay, but when you're talking about pay components when it comes to other trade negotiators, it's about investing in the United States, because that means money and jobs for Americans coming into the United States. This is purely about just paying some of your profit streams for chips that at one point you're already sending to China to the U.S. government. How is this in line with what the Trump administration and the campaign ran on?
Well, it's definitely not consistent at all. Either there was a national security threat exposed to these chip sales, which is something that we've been dealing with for at least a decade, or you can just pay your way around it and it's no longer a national security threat. They are two mutually exclusive developments. And I think, again, it goes back to the president needing more chips in the China negotiations because, for example, the export of U.S. soy and agriculture goods is down 50% in just the last 6 months, dropped from like $11.5 billion worth of sales to $5.5. The president needs more ammunition. And if he can somehow create a reliance which is what we've heard from the NVIDIA CEO on U.S. chip sales, then that gives some additional leverage perhaps down the line. But it's definitely mutually exclusive to the national security argument.
How much leverage do they have right now, Henrietta? I think that's worth exploring. If you look at the Chinese export numbers, they seem to be doing okay. The export numbers are up. The exports are just going to other places. Is this important to them in the same way it was maybe 6 months ago, maybe several years ago, 4 or 5 years ago?
Yeah, absolutely. And this is what you always have heard from China very consistently. The United States is a bully. Come do business with us. We're seeing it operate in Africa right now, and the EU and other nations in the Southeast Asian region. And one of the things to be mindful of as we get into this is that the president has threatened 145% tariffs. 80% would be the rate that goes into effect on August 12th if they don't reach a détente. But China plainly has the president in a corner around magnets and rare earths that debilitate the automobile and defense sectors in one fell swoop. So the reason that the 90-day pause is the base case on the street is because the president threatened too much. And he's not going to get it. We don't have the capacity for that. Goldman's coming out with 67% inflation hike to the U.S. consumer and prices being passed on. We do not have that ability right now. It's the same reason, not to go to too many places, but it's the same reason you're not seeing the Russia sanctions go into effect. You cannot mess with oil and gas prices when we have this risk of inflation coming.
What would be helpful is if the Europeans and other trade partners got on side with the United States to put the pressure on China, to put the pressure on other trade partners. Henrietta, do you see those pieces coming together anytime soon?
I don't. And think about what we have pending. You've got Section 232 pharmaceutical tariffs, automobiles, automobile parts, semiconductor chips, all those outstanding components. And the EU is not at all thrilled with the deal that was reached a couple weeks back with the United States. So that block is fractured to the point where we don't even have legally binding text, and we might not for months now. So I don't see that coming around. We don't have Canada even. So I think we're quite a ways away.
What kind of weight does the U.S. have when it goes to Brussels and say, really put the screws to China, given the fact that now the United States is saying, well, actually, we'll send some chips that we thought were national security concern, but you just have to give us some of the profit?
This is really the underlining issue that all of our trading partners has had. Who is the ultimate decider? Where is the line in the sand? What are we even negotiating? And that's been a consistent theme that we've seen from Japan and Korea and the EU is what is it that we can offer? What can we commit to and write into legally binding text on our end that we can then go and operate with around the world? And that's not something that they have any ability to even get in the room in a timely manner to have that conversation. And there are so many outstanding issues. And I would just say one more time here, the market is the inflation is not a one and done situation. We're still going to get lumber tariffs on Canada on top of the ones that the president put into effect on Friday. We still have outstanding sectoral tariff risks with all of these major trading partners from Switzerland to Ireland. There's no certainty here, and I don't have any reason to think that would end in the next 3 years.
Just briefly, how much money is coming in the meantime, Henrietta? Just how much are we taking in month on month at the moment?
I think last I saw was $27 billion a month. So ultimately, this is a $2.7 trillion revenue raiser that the United States consumer pays for. And the inflation numbers are going to get compounded because, again, this is not a one and done event. Tariffs have increased at least a dozen times just in the last 6 months. And there are 9 on the horizon just in the sectoral tariffs, without even getting into 301s on Brazil or the IEEPA tariffs and whether or not those can be maintained. And then we're going to throw export control restrictions on top. There's a long way to go.
Henrietta Treyz, of Veda Partners. Henrietta, thank you. Thank you very much. A lot of money coming in. Some debate about what to do with it.
Well, yeah, and I think when you look at what this administration is trying to do is they want this External Revenue Service, basically bureau, to try to bring down the deficit. Big question about money coming in potentially from these chips. What are they going to use it for?
Up next on the programme, we'll catch up with the former Boston Fed President Eric Rosengren on the risk of stagflation. Plus, Yahara Anand with your morning movers. AMC trading higher in the pre-market as consumers head back to the movie theatres. Remember that jobs report? A lifetime ago. Since then, the best week since June in the equity market, all-time highs, and in high-yield credit spreads tighter, tighter for 5 consecutive days, every single trading day through last week. This morning, equity futures positive by 0.1%, adding some weight to the rally on the Nasdaq 100, just about positive also. 2 hours away from the opening bell with your morning movers. Here's Yahira. Hey, Yahira.
Hi, John. We start with Intel getting a bid here, up 1.7% as the Wall Street Journal reports that Intel CEO Lip Bhutan will meet with President Trump at the White House today, with Tan in a delicate position as President Trump calls for him to resign over his ties to China. So not only is this company in a tough position as it's missed out on the AI chip boom, now it's caught in the crosshairs of this Trump administration. And the natural question now is whether Intel will commit more money to its U.S. investments. And get out your popcorn because AMC results are out and they were strong. So you are seeing the stock pop nearly 10% here. Results showed a 35% jump year over year in admissions revenue as audiences keep returning to theaters despite all those media companies spending so big on their streaming. But people still want to go to the theater. And while they're there, they are spending with food and drinks with that category up 36% year over year. So consumers still willing to spend $10 on a bag of popcorn. And we're sticking on this theme. We're seeing Warner Brothers Discovery up 1.5% after their horror film Weapons topped the domestic box office this weekend. And this marks Warner Brothers' 7th #1 debut this year. And according to ComScore, overall U.S. box office revenue hit more than $130 million for the weekend. That pushes the yearly total up 7.5% from last year, echoing the strength we heard from AMC. John?
It's good to see. Yahira, thank you. Thank you very much. Very good to see. I think we even got Annmarie into a movie theatre, didn't we?
Yeah, I did.
In the past few months. Nice.
I went to go see Mission Impossible.
First time in 5 years?
About, yeah.
What held you back?
But I didn't really enjoy the movie. But, now, it's nice to get out.
It's good to see you encouraged. Get out there. Spend some money. Support the US economy. On our radar this morning, the government striking a deal with chip makers. Sources telling us here at Bloomberg, Nvidia and AMD agreed to pay 15% of their revenues from Chinese AI chip sales to the US in order to secure export licenses. Those two names trading slightly lower so far this morning.
So this one was a real surprise. I mean, how many times can we say this is unprecedented? This is highly unusual. You put it best. Paying to play. And this whole saga is interesting to me because these chips that they're now going to be making money off of, the U.S. government first deemed were unwilling, should not be sent to China because of national security concerns. They said this was helping the Chinese military. Then they used them as a chip, a negotiating tool to get those rare earth magnets from China. And now they're saying to the companies, well, we're going to give you back the licenses, which we know you can make billions of dollars off of China, but we need to get profit from this. I think what's interesting about this story is what happens next. Who next could potentially be one of those companies that the U.S. government is going to call and say, you need our help with something? Well, you're going to have to give us some of the revenue.
Still waiting for chip tariffs, aren't we?
Yes, semiconductor tariffs.
Yeah, what's happening with that?
Well, what's interesting about the sectoral tariffs when it comes to semiconductors is President Trump came out last week and said it's going to be 100%. Shock and awe moment. Tim Cook standing next to him. 100% fine print, that little asterisk. Unless you invest in the United States. Now, all these semiconductor companies have some money investment in the United States, so guess what? They're not going to have a semiconductor tariff.
We'll get to Tim Cook and Apple a little bit later in the programme, 8:15. We'll catch up with Dan Ives of Wedbush. Look out for that conversation. Wanted to turn to this story. Lithium prices and stocks spiking after CATL halted operations at a major mine in China. This coming after weeks of speculation that authorities wouldn't extend the mine's license. The move sparking concerns that Beijing might suspend other projects as well.
So this comes that we have this supply glut, and it has been exacerbated by demand headwinds for EVs, especially given even the Trump administration rolling back some of those incentives to want to go buy an EV. I also view this potentially as another moment of a tea leaf when it comes to Beijing and Washington. What has been consistent from Treasury Secretary Scott Bessent is what China's been doing in terms of overcapacity and basically just flooding the market, the U.S. market, the European market, et cetera, with cheap goods. Maybe this is part of that agreement and the talks that are happening behind the scenes when it comes to these two economies.
Possibly, but I think they'd prefer they went to things like steel, things like autos. There's a long, long list of things where this administration and others, because they agree with them, would like to see things happen on Chinese overcapacity and overproduction.
Absolutely. But potentially, maybe, this is an olive branch and a first step when it comes to China. But again, this is also just the fact that the demand just isn't there at this moment because of the headwinds facing that EV market.
That's the latest between the US and China. I wanted to turn to the latest between the US and Russia. President Trump planning to meet with Russian President Vladimir Putin in Alaska on Friday. Sources telling us here at Bloomberg that European leaders are hoping to talk to the president before the meeting takes place.
Because the European leaders want to make sure that they are saying to the U.S. president their concerns about what potentially could be agreed upon. And there's been a number of discussions, even with J.D. Vance, the vice president, sitting down with European counterparts. What comes of this, we do not know. We do know that Trump, though, has gotten very impatient with Vladimir Putin. And to that respect, maybe this is why the Russians are willing to sit down. I think for Putin, and based off some conversations I had with individuals who watch Russia closely, this is a win-win. If you can get Zelensky to agree on the territorial mapping that we have right now, which is basically give up the entire Donbass and Ukrainians need to get out of Luhansk and Donetsk, then that's a win for Putin. If they don't, then Putin just continues fighting. But he could say, I gave it a try.
So one to watch later this week. That story will kick off on Friday. Let's turn back to the economy and the Federal Reserve. Governor Mickey Bowman favouring 3 interest rate cuts this year in a speech produced over the weekend, promising to prioritise the Labour side of the dual mandate. Bloomberg's Mike McKee joins us now for more. Mike, good morning, sir.
Good morning, John. Well, Annmarie was saying a minute ago about talking about all the unprecedented stuff that's happened lately. This is precedented because Mickey Bowman was one of the 2 who dissented at the last meeting. And she's making the same argument that she made before and the same argument that Chris Waller is making. If you wait too long to cut rates, the labor market's going to collapse on you. She's ready to cut rates 3 times before the end of the year, saying a proactive approach would help avoid a further necessary erosion in labor market conditions and reduce the chance the committee will need to implement a larger policy correction should the labor market deteriorate further. That's the same argument, as I said, that Chris Waller has made. Mary Daly making a similar argument last week as well. So we're starting to get some people turning in the direction of the dissenters. We're looking at on board to cut those 3, not yet Bostic, Hammock, and Musalem. Musalem saying he's still worried about prices a little bit more than he is about the labor market. And Cook and Collins last week saying they're in the maybe camp now. Of course, we've got Stephen Myron coming on board, but I'm guessing he's not going to be there for the September 17th meeting, not confirmed yet. But if he was, that would be 4 people. The only trouble is we may not have any dissents in September, because if tomorrow's CPI comes in relatively restrained and we continue to get some bad news on the labor front, then the rest of the Fed is probably going to be on board with at least a cut in September. So a lot of ground to cover between now and then.
Mike McKee, thank you, sir. Let's build on that. Joining us now, the former Boston Fed President, Eric Rosengren. Eric, welcome back to the programme, sir. Some healthy debate at the Federal Reserve. Let's call it what it is. It is healthy. Do you think September is too early to settle the debate?
I think it depends on how the data comes in. We have 2 CPI reports, 1 PCE report, and 1 employment report. The data can be pretty noisy, so I think we need to see what things look like as we get into September. But I agree that if the CPI and PCE are reasonably well restrained and the labor market looks weak, then it would be appropriate to ease rates. However, it's also quite possible that we'll see a slowly increasing inflation rate. I'm expecting the CPI will probably be, the core CPI will be above 3% when it comes out tomorrow. And if we start seeing numbers that look higher than the market's expecting, sentiment can change pretty quickly. So I think it's a little too soon to call September. I think the Fed was acting appropriately when it wanted to wait and see, because right now, while the payroll employment was weak, the unemployment rate was 4.2%. And the labor market has had a labor supply shock, so you probably want to focus a little bit more on the unemployment rate than the payroll employment numbers.
Eric, as you look at the dual mandate at the moment, and this really speaks to the divide of the Federal Reserve, there are some individuals who want to focus on the employment side of the mandate, others who still want to focus on the price stability side of the mandate. Can you share with us your experience? Did you prioritise one side over the other? Are they created equally?
So everybody can vote and weigh. I mean, you're not given the weighting function. So each person can kind of choose for themselves what they think is most important at the time. But the framework document actually talks about what you should do when both elements of the mandate are not where you want it. And in that document, it argues that you should look at how far away you are from where you want to be and how long it'll take to get there. So on inflation, if you look at the core PCE, we're at 2.8%, and most people think it's going to take quite some time for us to get back to 2%. If you look at the unemployment rate, we're right at 4.2%. So despite the weak labor supply that's been happening, the labor market doesn't look to be in that much trouble. You don't see initial claims rising rapidly. So while I know a number of participants at the FOMC are talking about concern about the employment mandate, it actually is exactly where they forecast they want it to be, which is at full employment.
Basically, what you outlined there says that the Fed shouldn't be cutting just yet. So is there a bias to a weakening labor market?
So it depends on a forecast. And I would say private sector economists do not see a rapidly rising unemployment rate and do not see an elevated risk of seeing a recession. So I would think the rhetoric around the labor market would be more consistent if the private sector was seeing more evidence in the data that the unemployment rate looked like it was going to rise, that initial claims was going to rise. So I think at this time, it's a little bit odd to overweight the employment part of the dual mandate.
Eric, can we just sit on the data? And I want to avoid the politics. Don't worry about that. Not going to include you in any of that whatsoever. We're always dependent on the data, and there's been a question for a long, long time about how dependable the data actually is, particularly the labour market data prone to very large revisions. We saw that last year. We've seen it many times in the past as well. Eric, how did you manage that situation? Were you less sensitive to incoming monthly reads, knowing that at some point in the future they would be revised? How did you approach it?
So if you focus on a forecast, month to month doesn't matter nearly as much as where you expect things to go over time. And as you point out, the labor market data, particularly the payroll numbers, can be pretty jumpy. And the reason for that is not because anybody's manipulating it. It's because they do a survey, and if people don't fill out their survey forms on time, then in the revision, they pick up the additional surveys. And so depending on what the response rate is, and the response rate has been going down on many U.S. government surveys, it becomes less accurate, and the revisions can be larger as they get additional data. So you never should put too much weight on any one data point. You're really looking for a trend. You're not actually looking for, while Wall Street focuses on beating expectations and having a number, comparing the current number to what they expected, central bankers should really be worried more about long-term trends. So long-term trends don't get affected as much by a single data point. So you should smooth through most of that data, and that's what most forecasts end up doing.
Eric, do you think there's concern, though, that now the U.S. data is no longer considered the gold standard, given the fact that the president ousted the commissioner of the BLS?
Well, it depends on who replaces at the BLS, but it would be very disturbing if you didn't have reliance on the data. And the U.S., not just the BLS data, but the GDP data, the inflation data, all that data is critical to making good policy choices. And if that data is manipulated in some way so that you can't rely on it, it becomes very problematic for policy. And while the initial changes are probably not going to be that noticeable, over time it can create havoc. And I think you see examples of that. And the Wall Street Journal did an article on what happened in Argentina when they started manipulating the data. China has been famous for dropping series that didn't work in the way they were hoping. So, for example, youth unemployment is not reported anymore on a consistent basis. But you see young people coming to the United States because they can't get jobs in China. So you can conceal to some extent data, and for month to month you can get slightly better numbers. But over time, if you're manipulating the data, it becomes obvious to the public.
Eric, the president's nomination to fill Governor Kugler's seat, Stephen Myron, is an individual that is already working with him as one of his economists, the head of the CEA. Less than a year ago, Myron was against cuts at the Fed. Does he look purely political now, potentially, to his new colleagues at the FOMC?
I think there is a consistency problem. He has traditionally been somebody very concerned about the inflation part of the mandate. And so his newfound interest in the labor market and the need to lower interest rates looks somewhat out of character from what he was concerned about over time. He's written about being concerned that there's too much politics at the Fed. He obviously has been a strong proponent of this administration's policies and seems to be a proponent of lowering interest rates, which has been advocated by the administration. So if what you're looking for is an independent Fed, he probably is not the perfect choice to ratify an independent Fed.
Eric, appreciate your opinion. Thank you, sir. The former Boston Fed president there, Eric Rosengren. Stephen Myron, of course, will have plenty of opportunities to explain his views in due course. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. The U.S. expects to largely complete negotiations with countries that have yet to secure a trade deal by the end of October. That's according to Nikkei Asia, citing an interview with Treasury Secretary Scott Bessent. They said Bessent reaffirmed the importance of the Fed's independence, but said the next central bank head should be very attuned to forward thinking. Meanwhile, Palantir is now the most expensive stock in the S&P 500 as it trades at 245 times forward earnings. The stock has soared about 2,500% since 2021 and closed at a fresh all-time high on Friday. Palantir has been boosted by growing AI use, its business ties to the U.S. government, and stellar earnings. And President Trump continuing his attacks on Fed Chair Jay Powell while announcing he would hold a press conference today on making Washington, D.C., quote, safer and more beautiful. He also vowed to stop people from spending billions to fix up a building when there are other problems to solve. Of course, referring to the renovation of the Federal Reserve Building. That's your Bloomberg Brief. John?
Thank you. Thank you very much. More from Yahara in the next hour. Up next, upside, inflation risk.
There are still risks to inflation. We are going to see more inflation in terms of core goods, but we're seeing disinflation on the services side that is offsetting some of the inflationary forces on the goods side.
In just a moment, we'll catch up with David Rogal of BlackRock, live from New York. You're watching Bloomberg TV. Live from New York City, welcome to the program. Under surveillance this morning, upside, inflation risks.
There are still risks to inflation. We are going to see more inflation in terms of core goods, but I think the reason that the market has been able to digest it and the Fed is going to be able to look through it is because we're seeing disinflation on the services side that is offsetting some of the inflationary forces on the goods side.
So here's the latest this morning. Investors are awaiting inflation data this week. CPI and PPI on deck. David Rogal of BlackRock writing, we still think services inflation is an ongoing improving path. Tariffs are likely a one-time price boost. David joins us now for more. David, good morning.
Good morning. How are you?
Will the FOMC agree with you in mid-September?
I'm not sure. I think, but I do think the case for maintenance cuts has improved in the last couple of months. For the last 5 months, we've seen inflation around 2%. I think what you're seeing is that you're going to see in the next few months goods price inflation move up a little bit off of low levels. The last month on July data, we saw the goods price data move up to around a 7% annual rate, but we saw services inflation offset that. I think on the next few months, you might see some of those services prices stay a little stickier than they have been. You're likely to see some more tariff impact, although we're not sure exactly how much. But I think overall, my view is that tariffs are more of a consumption tax. They're really more of a supply side shock. The fear, I think, with the Fed is that tariff inflation alters inflation expectations. You've seen some of the inflation expectations move higher. So, but I think at the end of the day, we're talking about a consumption tax. Unclear how much of that is absorbed by price, margin, and exporter, but I think the large majority of it will be absorbed through higher prices.
Let's push these views through the bond market. And what we saw last year take place was pretty clear. Fed drops rates 100 basis points, long end rejects it, and yields rise 100 basis points on 10s. Are we set to see a repeat of that in the months to come into year end?
Well, it feels eerily similar to last year, honestly. Even the July data, with the Fed waiting in July, getting a rise in the unemployment rate last year, then to this year we saw the revisions. It feels eerily similar. I think what you're seeing is in the front end, we have a fair amount priced into the market, particularly around the Fed transition. We're now pricing policy rates at the end of next year around 3%. And when I talk to people about where they think neutral rate is, that's somewhere in between, the kind of the 2.5 view and the 3.5 view around neutral policy rates. And so I think there's a fair amount in the price. We're still focused on that 2 to 5 year part of the curve relative to the long end because we still think there's going to be more term premium. The supply-demand imbalance in fixed income is not as favorable as it used to be. And so we're still sticking to that part of the curve. Relatively fully priced at the lower end of the range, but I think you still see bonds relatively well supported overall.
The Fed has obviously bruised what happened with COVID and inflation and the whole transitory debacle. What makes this time different?
I think the difference, it's really interesting. It's very possible that tariffs are more of a transitory price impact, whereas before, I think with COVID era inflation, what we saw was this helicopter money stimulus. It was demand driven. It was also driven by the mix shift. We had this rapid mix shift from services to goods, and global supply chains weren't ready for that. This is very much like a tax and consumers probably reorienting their spending. Interestingly, in the CPI data, you've seen discretionary spending, I think, pull back a bit this year. We've seen very weak travel demand, weaker travel prices. That's part of what's been bringing down services inflation alongside somewhat stickier goods price inflation. So I think the shock that we're going to see here, we're still not sure of the magnitude, is much more similar to a supply side or a consumption tax effect than it would be a demand-driven inflation surge.
Right, but for corporate America, if they have to potentially cut costs, consumers are unwilling to pay higher prices, is that going to potentially mean layoffs?
It's really hard to say so far. I mean, so far, earnings have been okay, and the economy's been pretty resilient. The labor market has slowed. It depends on how much can be pushed through in price. I mean, some sectors have more pricing power than others. I think what we're seeing in the auto sector is that pricing power is more limited. But our view is still that the majority will be passed through to higher prices.
No sign of markets carrying at the moment. Equities at all-time highs. Some people might say that's just equities, that's just tech. High-yield credit spreads, though, keep getting tighter. What do you and the team see in high-yield credit?
Well, we remain pretty constructive on the economy overall, notwithstanding some of these forces that are slowing things down, like immigration slowing, uncertainty on tariffs, tariffs as a consumption tax. We see a lot of positive offsets with regards to deregulation, business-friendly policies, healthy corporate balance sheet, healthy consumer balance sheet. We're on this big CapEx boom related to AI and infrastructure spend. So I think there are a lot of positives. We still like high yield. I think corporate credit spreads in aggregate, risk premiums relative to treasuries, extremely tight historically, lower decile, but then the all-in yield is probably above where median levels are over time. So I think investors are very focused on the all-in yield. We've been focused on moving, we're overweight high yield in our portfolios.
Yeah.
We've been focused on moving that regionally outside the U.S. into Asia and parts of EM where we're seeing much more credit selection opportunity. We see credit dispersions pretty low in the U.S., and so we see more security selection opportunities. It's part of a broader theme in our portfolios, which is to really try to tap a broader set of opportunities in this environment.
David, appreciate your time. It's good to see you, sir. Thanks for dropping by. David Rogal there of BlackRock.
Our near-term outlook on equities isn't great.
Some of those valuations seem much more ephemeral and .com-like.
Overall market's really not that expensive once you take out the Mag 7.
A key word for investors now and always is diversification.
It's really about long-term investing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
90 minutes away from the opening bell, the third hour of Bloomberg Surveillance starts right now, live from New York City this morning. Good morning to you all. Equity futures on the S&P 500, pretty stable at the moment, positive by 0.2%. Coming into another trading week at all-time highs on the Nasdaq 100, up by 0.1%. Your week ahead includes an inflation print coming tomorrow morning at 8:30 Eastern Time. Retail sales on Friday, sandwiched in between this deadline for a truce between the US and China. Widely expected to get a 90-day extension for all of that. But once again, the focus on that relationship and the chip makers and their ability to access that market.
Absolutely. This comes when it comes to these export licenses and these export controls we saw from the administration in April. There was a U-turn on them when it comes to the H20 and NVIDIA and an AMD's MI308 chip. And now what we are hearing is that the administration is going to start the export licenses once again. But to get those licenses, you need to give the U.S. government 15% of the revenue you're getting from selling those chips into China. This is unprecedented. This almost has a feel of central planning in a capitalist society, which has the business community, I think, a little bit concerned. And on the other hand, you have China hawks in Washington, D.C., incredibly concerned. Not because of the 15%. They were concerned when you started using these high-tech chips at the negotiating table with Beijing.
Who else should be uncomfortable beyond AMD? Beyond NVIDIA, how many other companies are facing the same situation through the rest of this year?
Well, this is the big question. If the Trump administration is successful in getting AMD and NVIDIA to give them 15% of their profit for allowing them to sell into the Chinese market, then who's to say that there's not going to be other companies that are, what you said, Jonathan, all morning and exactly correct, paying to play?
A lot of friction being introduced into the global economy. Equity still doing okay, close to all-time highs. A week of gains, the biggest week of gains since June just last week, following that ugly payrolls report. A distant memory. Coming up this hour, David Lebovitz of JP Morgan Asset Management with stocks near record highs. Dan Ives of Wedbush as the White House takes a cut of chip sales in China. And Stephanie Roth of Wolfe Research looking ahead to the latest read on inflation. We begin this hour with stock steady as traders await a key week of data. David Lebovitz of JP Morgan writing the following. We continue to expect a slowdown of growth in the back half of 2025, and that is beginning to materialize in the economic data. However, this is an economy that is slowing and not stalling. David joins us now for more. David, good morning.
Good morning. How are you?
Does that mean we can look through it all?
So I think the big question here from my vantage point is, one, when you think about the jobs report that we got for the month of July, it was actually a reflection of some of the other data that we had begun to see come through. If you think about the past couple of months of personal income, personal spending, retail sales, all looking a little bit soft, but hey, the jobs numbers were okay until they weren't. I would point out, though, that the jobs numbers weren't terrible. We still added, 86,000 private sector jobs in the month of July. The revisions caught people's attention. But the one silver lining to that report is the fact that hours worked increased and wage growth remains right near 4%. And so what we're seeing in this economy is not a whole lot of hiring, not a whole lot of firing, but we can treat it as a going concern because individuals and consumers are getting that cash flow, which they will turn around and spend. And so we are looking for growth to soften a bit here, but not necessarily shoot off the edge of a cliff.
How relevant is that data for where the equity market trades?
So I think this is one of these environments where the stock market is not the economy. That's what's really come through to me. You think about the second quarter earnings season, more than 80% of companies beating estimates, year-over-year growth, quarter-over-quarter growth, both positive. You look at the economy, we had no growth in the first quarter. We had 3% growth in the second quarter. We're kind of just humming along at trend. And so against this backdrop where the labor market is kind of in this equilibrium and the economy is moving back towards its long-term trend pace of growth, you're seeing this profit story, which is still very robust. Companies are making money despite an economy that somewhat is uninspiring.
And they're making money despite higher tariffs.
Exactly.
What's going to happen when the higher rates actually start to bleed into this market?
So I think it's a timing issue more than anything else. And the problem with people in my line of work, right, is we like to shock the model. We assume that it's all going to show up at the same point in time. This is going to be much more gradual than I think people anticipated. And furthermore, as we've seen, there's room for things to move around even once they've allegedly been set in stone. And so what I think you're going to see here from a growth perspective is an economy that kind of bumps along into the end of the year and then reaccelerates in the beginning of 26 as we get the sugar rush from the fiscal stimulus, you're going to have inflation that is just kind of sticky, but you're not necessarily going to see a big pop. And what our work has shown over time is that it's really the inflation surprise rather than the level of inflation itself, which can be problematic for both stocks and bonds. And so I think equities are just focusing on the profit story, and I do think that there's some durability here.
Do you think they're ignoring maybe some of the signs we are seeing, like that ISM services report?
You know, the survey data has been mixed in terms of its track record since COVID in terms of tracking the actual data. I think what you're seeing, and if you read through some of the commentary that came through in the ISM services report, you had concern about tariffs, but you also had concern about labor. And so I think that could well be the bigger issue as we move into 2026. We've seen this massive reduction in immigration and labor supply. What does that mean for wages, and what does that mean for inflation? Because that's what's going to make the Fed uncomfortable if they see wage growth reaccelerate.
If you're watching this right now, you've heard people get crazy about tariffs, about the data, about the Federal Reserve, and then they watch Microsoft come out and put up massive numbers. And they keep asking a question I've already asked, which is, does any of this matter? Should we care about it when it comes down to a handful of names of the S&P 500, which make up a big weighting and keep delivering?
So I think that there are a couple of dynamics to keep in mind. One is where we were back in April, right? So all of this feels much more comfortable than what we were dealing with around Liberation Day. Two, at that point in time, there was no information. And what you're hearing from companies today is, hey, you know, there are going to be tariffs and we have a plan for dealing with those tariffs. And then you get the big tech names in the S&P 500 that have a plan for dealing with the tariffs. They're growing their profits. They have a tremendous amount of cash on their balance sheet. It's tough to get too negative about those types of businesses in this environment. And so from a portfolio perspective within the U.S., we've really been leaning in more to things like tech and communication services, trying to use a bit more of a scalpel as opposed to a sawzall when allocating to the U.S. equity market.
Clearly, we've got concentration risk in the United States, but I'd be asking a question repeatedly whether that is downside risk or a source of stability for a lot of investors at the moment.
I think more than anything, it's a source of stability. You know, these are not your father's tech stocks. This is a very different environment than where we were in the late 1990s. There are profits behind these businesses, and they clearly want to play ball. I think, you know, what we saw last week in terms of, you know, various tech CEOs kind of coming to the White House and being alongside the president, they recognize that the path forward for their company is going to be dependent on navigating an uncertain political environment. But, you know, the administration views uncertainty and volatility as an arrow in their quiver. It's a tool that they use. And so I think from a business perspective, what you're seeing CEOs say is, okay, this is the world that I'm going to be operating in. How do I most effectively operate in that world?
What are the companies you want to avoid? What kind of companies, which sectors?
So I think where you're going to see things get hit the hardest are really obviously in the goods space, but more specifically in areas like consumer staples. If you look at where consumer staples margins are relative to their long-term history, they're at the lower end of the range. That means that any increase in input costs stemming from tariffs is going to get passed directly through. And we've seen the consumer become more sensitive to the prices they're paying, right? In some of the earnings reports, companies talking about trading down, focusing more on private label. Pricing power, right? I think the prior guest said it. It's those industries with pricing power where you want to lean in. It's those industries where maybe I buy, you know, these paper towels instead of these paper towels that you may want to steer a bit clear.
Besides the 7 versus the 493, what else do you like?
We like financials. We think financials here are particularly interesting, one from a deregulation story, but also just from an economic growth story. And with consumers getting effectively a raise next year, given what's been passed in the big, beautiful bill, we think that that could stoke demand for credit and help traditional banking, who are obviously trying to take share back from things like private credit and very keen to get money in motion.
The deregulation story is a little bit harder to track.
Yes.
How far along are we?
So I think it's one of those issues where it's being worked on in the background, and you know it comes out in conversation when markets start to get a little bit rocky. So we're still going to be dealing with the carrot and the stick, and I think that that's just the environment that we're going to be in going forward. But I do think that you'll see deregulation begin to gain pace, particularly as we get more clarity around what's going to happen at the Federal Reserve. And obviously there are some questions there right now, and I think we need to be sensitive to the fact that I think it was being said earlier. Central bankers focus on the trend, right? Central bankers don't focus on what the monthly data print is going to be. And if you look at some of the trends in inflation, yes, they look okay, but I'm not really sure that inflation is where the Fed wants it to be. And the labor market still looks okay. And so these calls for 2, 3, 4 rate cuts, they need to get going, they're already too late. I think that those are a little bit displaced. And I do think that while the door to 2 cuts is more open than it was a couple of weeks ago, I think that it would be inappropriate to get too excited about a massive Fed easing.
Stuart Kaiser of Citi saying the best case might be the base case. And the base case at the moment is 2 cuts this year.
Exactly.
And if you end up with more, it's not for good reasons. And if you end up with less, it's not for good reasons.
Exactly.
Is the base case the best case?
I think that the base case is the best case. I think markets would be... It's a question of surprising investors, right? And the Fed at the beginning of the year said, we think we're going to cut twice. If the Fed ends up cutting twice, there are no surprises there. The Fed cut once, I think that the market can digest that. But I think the bigger risk is that we get more of these cuts coming through, because the only reason that you're going to have a Fed cutting more aggressively is because they see some problem in the labor market. And that's going to be a problem for the economy, despite the stimulus that's coming through in 2026.
David, it's good to see you.
Thanks
for dropping by. Thank you. David Lebovitz there of JP Morgan Asset Management. Equities positive by 0.2% on the S&P, with an update on stories elsewhere with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. NVIDIA and Advanced Micro Devices, known as AMD, have agreed to pay 15% of their revenues from AI chip sales in China to the U.S. government in a deal to secure export licenses to the country. The arrangement reflects President Trump's effort to engineer a financial payout for America in return for trade concessions. Meanwhile, President Trump is preparing to meet with Russian President Vladimir Putin in Alaska on Friday to discuss ending the war in Ukraine. Meanwhile, President Volodymyr Zelensky said Kyiv won't cede territory to end the war with Russia. European leaders pledged their continued support for Ukraine's sovereignty, saying international borders must not be changed by force. And Justin Rose won the FedEx St. Jude Championship in Memphis yesterday with a sensational performance on the back nine. Rose made up a 3-shot deficit over the last 5 holes against Tommy Fleetwood, including 4 straight birdies. He then made 2 birdies in a playoff against U.S. Open winner J.J. Spahn to take home the trophy. That's your Bloomberg brief. John?
Yahara, thank you. Thrilled for Justin Rose. Shout out Tommy Fleetwood. Never won on the PGA Tour, keeps coming so close, keeps missing out, still speaks to the press afterwards. That guy, I just have so much respect for, week in, week out, for showing up, delivering at some ridiculously high levels. Just that close at the moment, that close, and can't get over the line.
That's sad, isn't it? Go so close, but yet so far.
Thanks,
I
Amber.
don't really know what you're talking about because I did not watch this.
Up next, the morning calls. I talk to myself in future with regards to golf. You know what I mean. Up next, we'll get you the morning calls. Plus, Dan Ives of Wedbush as NVIDIA and AMD agree to give up a cut of sales to China. That conversation just around the corner.
This new element of this 15% of the profits, it's really highlighting how transactional the administration is. And this is a president who's willing to take different approaches to all sorts of problems like trade negotiations. Here he's saying, okay, I'll let you sell your technology to China, but I'm going to take a chunk of your profits for doing so. This is something we've never seen before.
That was the former senior White House trade advisor, Kellyanne Shaw, weighing in on what we've seen with AMD and NVIDIA over the weekend. This morning, a good morning. Equities doing okay. Equity futures positive by 0.2% on the S&P. Positive also on the Nasdaq 100. That's the price action. Here's some morning calls. First up, Melius downgrading Adobe to sell, calling AI a growing competitive risk. Your second call from Wells Fargo, raising its price target on NVIDIA to 220, citing upside from new China export license agreements. And finally, Bernstein reiterating its market perform on AMD, noting renewed licenses in China offer upside potential. Sticking with both NVIDIA and AMD. Sources telling us here at Bloomberg the chip makers have agreed to pay 15% of revenue from sales in China to the US government. Joining us now is Bloomberg's Ed Ludlow. Ed, welcome to the program, sir. What's the reaction been from both NVIDIA and AMD?
It's not hugely surprising, right? That's what you hear in the semiconductor industry, because front and center of the president's effort to use the tariff tool as a levy, right? As sort of piece of fiscal policy. The emphasis on the AI industry has been to go after those corners of activity that are capital intensive, where there's committed investment. As you rightly point out, and our sourcing suggests, this is a quid pro quo. It's transactional, where the 15% revenue share is in order that AMD and NVIDIA get hold of export licenses for the specific AI chips that are designed for that market. That's the price of access. But I was on MODL and I, reading the notes, the most bullish side of the street sees them returning to growth in that market quickly if they can shift the gear. So in NVIDIA's case, if they have a fiscal quarter where they're doing $7 billion of China AI accelerator sales, the United States will book $1 billion out of that transaction. It's unprecedented in the modern era. And the final bit that people talk about is, is it a good thing for NVIDIA and AMD? Well, you should note that in the rest of the technology sector, you have US officials flying around the world dissuading companies from doing business with China. But China's a critical market for data center, and it's the price of access.
Ed, appreciate the update and looking forward to the coverage later on this morning. Ed Ludlow, Caroline Hyde at about 11 a.m. Eastern Time. With us around the table, Dan Ives of Wedbush. Dan, good morning.
Great to be here.
Did the price of an H20 chip in China just go up overnight?
By 15%. I mean, look, the reality, it's the cost of doing business, right? And I think when you look at Jensen, you look at anyone in the semi world, you need access to China. And it comes down to this is ultimately the path that they're going to have to go through. And look, in investors, it's a headline, sort of risk or shocker. But the reality is that you need to get into China. It's what you got to do.
Given where we were a few months ago, is this an improvement?
Oh, it's a massive improvement. I mean, if you go back to some of those dark days, where we were in April, some of those Armageddon days, it's showing at least now there is negotiations, right? And in that, it's essentially a game of high-stakes poker. So when you look at what's happening in tech, just like we saw with Cook at the White House and everything else, it's like, okay, if you play nice in the sandbox, that's going to be how this is going to work, at least for the next 3.5 years. And I think for big tech, you don't want to be on the outside looking in. And it's essentially the deal you can't refuse, right? I mean, to quote Godfather, it's like this is one where tech companies need to go down this route to get access to China. And I think on the other side, Trump administration recognizes, hey, if we don't give them access, it's going to make China that much stronger, Huawei, everyone else.
Is this the new rules of the road, though? You have to basically pay off the U.S. government?
Look, I mean, we're in unprecedented territory, and I do think you're starting to see big tech CEOs better understand the rules. And I think that's why if you're on the outside, it's not a good spot to be. Now, from an investor perspective, you'll pay the 15% tax to get access to China.
And that's worth it.
It's worth it because relative to the market and relative to the opportunity. And even though there'll be a lot of questions in terms of what this means, I think overall, relative to the last few months, it's much more bullish for U.S. tech and semis and NVIDIA and the godfather of AI, Jensen and everyone else to have access to the China market.
NVIDIA's got a strategy and investors like it. Apple's questionable. You've come out and said this is the BlackBerry moment for Apple. Why?
The reason it's a BlackBerry moment is that when it comes to AI, it's invisible, the strategy that Cook and Cupertino have. And right now, this is essentially, in big tech, it's an F1 race in Monza. And Cook is on a park bench drinking lemonade, watching it go by. Internally, it's not going to happen. There's no development that's going to happen internally to get Apple into the game when it comes to AI. And we've talked about it, whether it's Perplexity, whether it's despite regulatory doubling down on Google in terms of a Gemini partnership, or getting new blood in, getting new leadership under Cook. Because look, this is, I think when you think about Cook's legacy, which has been so historic, this will tarnish his legacy.
When I think of his legacy, I think of buybacks and supply chains. Is he the right man to lead this company?
Look, I think it's a key moment for him. I believe he is to be CEO, especially for the coming years, but you cannot be the biggest consumer base in the world, 2.4 billion iOS devices, 1.5 billion iPhones, and miss the fourth industrial revolution. And that's why it comes back to those WWDC events that we are at. It's a back to the future moment. You feel like you're back in 2016.
They like being late. Is being late an option on this one?
No. And look, being late is one thing, being casually late, this is something where you can miss the moment. And that's why the reason we call it a BlackBerry moment, because it's not just going to be about, okay, we have an orange iPhone this year and this is the little
You think he needs to bring in new talent, but they've already lost top talent to Meta. Why do you think he's going to last till 2030?
Because this is, I believe they got to rip the Band-Aid off, change the DNA in Cupertino. Look, no one could argue, and we've been one of the biggest supporters of Apple to where they are today. But you got to recognize the game's change. And in the AI revolution, in wartime CEOs with Zuckerberg and Musk and everything you've seen, obviously from Nadella and Jensen, you cannot just sit there watching this go by. And even if they did a Perplexity deal, and you talk about, and that was a $30 billion deal, it's a drop in the bucket relative. But the longer they wait, that continues to be the overhang. A huge overhang was lifted last week in terms of tariffs and obviously in terms of what they did in the White House. But the elephant in the room continues to be AI.
What about the Google Gemini partnership?
Look, it comes down to, as I covered Microsoft in the late 90s, you could add, Gates' bomber biggest regret was during all the regulatory DOJ, they didn't go after some of the biggest technology trends. And they ultimately won that case. Now for Google, and it comes to Apple, you cannot just sit here and just be on that treadmill at 2.5 speed. They got to focus, and I believe when it comes to partnership, that's something that they're going to have to seriously, aggressively consider.
What is this investment commitment all about? Who are they kidding here? How much money are they actually going to invest in this country?
Well, look, that's why, if you go back to, we've always said, the chance of them making an iPhone in the U.S. is a fairy tale.
Okay, so that's not going to happen.
And the reality is, they'll continue to invest more in AI and some of the other investments.
What do they consider as investment? How much are they currently spending on CapEx on any given year? Look, can they hit the numbers they're trying to say they're going to hit when they sit in the White House with the president?
It goes back to 4 years ago, what they talked about and where they are today, right? Has a lot of that come to fruition? I think for Apple, that was we talked about it, Cook, 10% politician, 90% CEO. That was a smart move. But I do believe this administration is watching carefully their investment. And if they feel that there's a little look over there moment, they will come.
You're the analyst. Do you think there is?
I think there's definitely risk here. And I think the elephant in the room, I think the bigger thing is it's not necessarily even about investment in the U.S. It's about make the big AI investments. And you could kill two birds with one stone. Do it in the U.S. That's where you're going to innovate. Because iPhones are not going to be made here. You could also do that with an acquisition. And you could have happiness in 202 as well as on Wall Street relative to what Apple needs to do.
Final question before you go. You've got a new clothing line. Congratulations. A lot of people responded to this in the obvious fashion. They responded, excuse the fun. They're coming out and saying, if Dan Ives has a new clothing line, then this must be the top.
Sure. I get the whole Ives clothing line at the top. But again, this is also because I believe, for years, I've wanted to create clothing that, many could go out of the box, more color. But as I've said, in this AI party, it's still 10 p.m., it was 9 p.m.
Okay.
Party goes to 4 a.m., and now you have some new clothes that you can wear.
Okay, and we might be blinded along the way. Dan, appreciate it.
Thank you.
Congrats as always, sir. Dan Ives there of Wedbush on the latest with big tech, on AMD, on NVIDIA. Up next on the programme, we'll catch up with Stephanie Roth of Wolfe Research on why tariff impacts on inflation may be worse than expected. With inflation data just around the corner, CPI tomorrow morning, the main event on the data front at 8:30 Eastern Time. Going into that data print, equities are doing okay. I keep saying this, we're coming into the week at all-time highs on the Nasdaq 100, close to those levels on the S&P 500, and the gains continue. Up another 0.1% on the S&P, on the Nasdaq up by 0.1, on the Russell, the small caps up by 0.3, and in the bond market starting the week with a bit of a rally. Firmer, yields lower. We're down 2 basis points on 10s to 4.26. The opening about 60 minutes away. Equities are firmer on the S&P 500 and on the Nasdaq, likewise on the Russell. Futures up by 0.13% with your morning movers. Here's Yahira. Hey, Yahira.
Hi, John. We start with the latest company to report results, and that is Weight Watchers. Shares are soaring up 10% after it issued a full-year revenue forecast, signaling confidence in its turnaround after the company filed for bankruptcy back in May. It had been rocked by the GLP-1 craze, but now it's leaning into that area and having some success. Clinical revenue in the latest quarter surged more than 50%, driven by growing subscriptions to its semaglutide-based treatment. So the future for this company appears to be less about points, more about shots, if you know you know. Next up, we have shares of AMC. They are also rising after a strong showing in earnings. They are rising 8.5% here. The results showed a 35% jump year over year in admissions revenue as audiences keep returning to theaters. And while they are there, they are spending on food and drink, with that category up 36% year on year. And we end on CoreWeave. That stock is also higher, up 3.6% on a new bullish call over at JP Morgan, which raised its price target to $135. We are almost at those levels. They highlighted CoreWeave's massive AI data center deal with OpenAI and long-term growth potential. This is a company that went public back in March, and it is up 220% since then, and the next catalyst could be tomorrow when it reports results. John?
Yahara, thank you. Appreciate it. Thank you for the update. Looking ahead to tomorrow, inflation data on deck, a key week of economic data. With your preview, here's Bloomberg's Michael McKee. Good morning, Mike.
John, I thought it was very nice of the government to wait till you got back to release all of this data, because it is going to be a very big week, and one number to rule them all is the CPI. If the CPI comes in relatively benign, we are probably going to be more on track for a rate cut. If it jumps, and watch the 3% mark for the core, it's going to be a problem. Tuesday and Wednesday, we get Fed speak, and we'll hear from Barkin and Schmidt and Goolsbee, who haven't spoken since the jobs report came out, and we'll get an idea of what camp they're going to be in after all of this. Thursday, we get PPI and jobless claims, always an eye on jobless claims. And Friday, our consumers hanging in there. We get retail sales and the University of Michigan, and we get import prices. Now, tariffs aren't reflected in import prices, but if exporters are raising prices ahead of the tariffs, or even lowering prices to absorb some of it, that may show up in the numbers. And all of this will lead us Friday afternoon to check this chart one more time, and that's the odds of a Fed rate cut right now at about 84%, 85%. That could go up significantly if we get a decent CPI report and no problems in the rest of the economy. Otherwise, we may watch it go back the other way. So a lot to keep an eye on, and we can do that now because John is back.
Mike McKee, I build my vacation around their data. You know that, not the other way around. Mike, thank you. Appreciate it. Thanks for the update. Looking ahead to tomorrow's CPI report, Stephanie Roth of Wolfe Research writing, we're looking for 0.31% core CPI, but risks to the upside. Stephanie joins us now for more. Stephanie, good morning.
Good morning.
Upside risk tomorrow, or upside risk through the rest of this year?
Tomorrow and then the rest of the year. And more so perhaps for the rest of the year. I think tomorrow's print could be a little bit elevated, but then as we move for the next couple of prints, that's when we might start to see the real tariff impact start to show up.
We've seen this tension between goods and services. Will we see that tension again tomorrow morning?
I think the problem is we're going to start moving in the same direction. So for a lot of this year, you've seen softer on travels in particular. That's putting downward pressure on services and then upward pressure on goods. They help to offset one another. For the next couple of prints, it might go in the other direction, in which case travel might start to pick up at the same time goods are inflecting higher. And that could pose a risk for some scary looking inflation prints in the next couple of months.
Sounds like potentially stagflation. What does the Fed do with this?
It's a tough backdrop for them. Perhaps when they're sitting here at the September FOMC, they might just take kind of what the market's giving them. That's kind of a question. That said, I think in the next couple of weeks, the markets might price in a lower odds of a September cut. So at this point, in our view, it's kind of 50-50. But the next couple prints might not look so great for the Fed to be able to cut.
Before the labor market report, it was a 40% chance of a September rate hike. Now it's like 95% chance after the labor market report. Now then we have two CPIs and one more jobs report. What do you think is going to be most important going to the September Fed meeting?
They're all going to be important, I think. And not just, if I had to pick one, I would say maybe the labor market report, just because the extent of the backward revisions were so significant. And our base case at this point is that we'll start to see the data inflect a little bit higher and the picture will look a bit brighter. We think the backward revisions were partially tied to the extent of the extreme uncertainty in May and June, specifically in June. Payroll processors submit companies that submit it via payroll processors, they might not have fully updated a lot of the job loss that happened within the month of June. Then they went back and revised it. So that explains the downward revisions. I don't think it's necessarily indicative of what's happening in the future. You're starting to see job postings pick up. Claims remain stable. The picture looks a lot better than at least the most recent 3 months.
Yeah, forgive the snark. This is the chairman of the Federal Reserve who anchored his view on the labour market around one data point, unemployment. He should feel pretty comfortable, even with the revisions a few Fridays ago, shouldn't he?
I think so, but I think you have to just wonder, to the extent that you're starting to see the significant downward, momentum in terms of payrolls. I think what we'll see after the next payrolls print, though, is an unemployment rate that still remains fairly stable, and then the last at least 2 months of jobs looking a little bit better, something around the 60 to 70,000 range, which is okay.
You've been warning about this for a while. Get comfortable with 60 to 70, maybe even 50, perhaps even lower. Just explain that a little bit more.
Yeah, so the steady state growth of payrolls has slowed down substantially. If you look at the last couple of years, it was running significantly above trend because of immigration. Now immigration has slowed down substantially, not only slowing, but they've also ended 500,000 visas overnight from May to June. So that's one thing that might help explain the extent of the revisions that happened in the month of June. The steady state pace of hiring has slowed down because of this. We were bringing in 75,000 people per month on Biden's parole programs. Those have been cut off, and those people holding visas are getting expired. So that should dramatically lower that steady state pace from something above 150 to something half that.
So you saying that basically labor market's more frozen than it is weak?
Yeah, I think it's partially frozen and partially just some funky labor supply issues that are playing out. You're starting to see lower demand in certain areas, but I think that might be just a function of the economic environment that happened in the past couple months as well. Looking forward, companies might start to realize that the backdrop is looking a little bit better than what they thought, and they might start to proceed with their hiring plans, which might mean the pace of hiring in the next couple months might be a little bit better than expected.
If the pace of hiring does get better, does the Fed then have more of a bias towards anchoring inflation?
Yes, I think that's fair. The September FOMC is tough because we're just coming off the bad revisions. They only get one more labor market data. But I think there's a decent chance that they end up potentially cutting in September and then it being forced to sort of stay on hold for a little while because the inflation data will start picking up, and that will really challenge the backdrop for them.
What do you think this Fed's going to look like in 2026? Is any of this relevant? How big a change are we going to see to that committee?
I think it'll be at the margin. We'll have someone a little bit more dovish at the top. But I think what we're starting to see with the list that has been percolating is they're looking for a more establishment type of chair, it seems. They're leaning in that direction. Certainly investment seems to be pushing for that because that's better for markets. Perhaps he's getting the message across that that's probably the better outcome for markets. I think what we'll see is a couple of additional more dovish members. It doesn't change the median that much, perhaps maybe one or two more cuts than would otherwise be the case.
What's priced for 26 relative to what's the median dot at the moment? What's priced for 26 at the moment? How aggressive are investors relative to what you're expecting too?
Yeah, I think investors are expecting 5 cuts maybe for the next couple of prints. And I think when we're talking to people, when I'm talking to clients, they seem to be a lot more worried about the labor backdrop than would otherwise be the case. So, yeah, maybe it's mixed sort of readings out there. But when you're talking to actual investors, the last payrolls print really jarred them, and they're wondering whether we've rewritten history, and there's actually the significant unraveling of the labor market.
Are they just not convinced by the supply side story?
Yeah, I think that's probably the case. And people weren't necessarily paying attention to this whole immigration story for quite some time. The focus had been on deportations, which is a sideshow to some extent, because deportations is not really what's going on here. It is the expiration of visas of people who are here legally, and now the administration has terminated those programs. So the parole programs in particular, that's about 1.5 million people whose visas are going to be expired in the next year.
And what industries are those people in?
A lot of it's blue-collar type industries, construction, retail and hospitality, meatpacking is another big one. So these are the areas that we should start to see some tightening in the labor market, which is perhaps one reason that we're starting to see a little bit of wage pressure. And this has been our call that we'll see a very low, steady-state pace of hiring, unemployment that's kind of steady, and then wage pressure start to build, at least at the margin.
So you can see a situation where payroll growth steps down, but slack doesn't increase. Because that's a really important distinction.
Yes, exactly. And that's kind of what we're looking at, because there's a real tightening in labor supply. Yeah, slight slowing in demand, but perhaps not massively so. And this is kind of the backdrop that we're living with, and it's hard for the market to digest that. And I think that's what we're sort of facing in the next couple of weeks. And it might be challenging for equities in the next couple of weeks as we digest some of the stronger inflation prints at the same time. But net, the economy is fine, and we're going to be running it at a place where growth is potentially inflecting a little bit higher. At the same time, inflation is also as well.
Stephanie, it's good to see you. As always, thanks for dropping by. Stephanie Roth there of Wolfe Research with an update on stories worldwide with your Bloomberg brief. Let's cross back over to Yohara Anand for more. Hey, Yohara.
Hi, John. Colombian presidential hopeful Miguel Uribe, who had warned that the nation was slipping back into its violent past, has died. Uribe's wife confirmed his death 2 months after he was gunned down while campaigning in Bogota. Uribe had been hospitalized in critical condition and underwent several neurosurgeries. Meanwhile, President Trump hopes that China will quadruple its soybean orders just a day before the trade truce between the two countries expires. The soybean push comes as U.S. farmers are just weeks away from their next harvest. As of late July, U.S. government data showed China has refrained from booking any cargoes for the upcoming season as trade tensions linger. And Micron shares are rising 5% in the pre-market. The company boosted its fourth quarter revenue and earnings outlook, citing improved pricing. Micron has been one of the best performing chip stocks this year, up more than 40%, but it disappointed investors back in June with an outlook that fell short of lofty expectations. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with the Flexport CEO, Ryan Petersen, on how supply chains are managing a brand new trading landscape. Live from New York City, you're watching Bloomberg TV.
I think we need to see what things look like as we get into September. And if the CPI and PCE are reasonably well restrained and the labor market looks weak, then it would be appropriate to ease rates. However, it's also quite possible that we'll see a slowly increasing inflation rate. I'm expecting the CPI will probably be, the core CPI will be above 3%. And if we start seeing numbers that look higher than the market's expecting, sentiment can change pretty quickly.
That was the former Boston Fed President Eric Rosengren joining us a little bit earlier, looking ahead to the September Federal Reserve meeting and looking forward to what we could see tomorrow morning at 8:30 Eastern Time with US inflation data. Here's a snapshot of the price action going into the opening bell about 45 minutes away, building on last week's gains. A big weekly gain, the biggest in fact going back to the end of June. Equity futures positive this morning by around 1/10%, building on all-time highs on the Nasdaq 100, just about in the green so far this morning. If you turn to the bond market, 2-year, 10-year, 30-year. Let's compare the front end to the long end. At the front end of the curve, the 2-year, anchored around the view that maybe this Federal Reserve is about to reduce interest rates. 2-year rates at about 375.60 this morning. At the longer end of the curve coming into Monday, yields higher, just a grind higher for 4 consecutive sessions. Yields a little bit lower this morning by a basis point at 427. But the big bet emerging on Wall Street is that maybe you see a snapshot, a brief pop in the long end compared to what you might see at the front end. Perhaps a repeat of what we saw last year and a much steeper yield curve. Front end rallies, long end sells off. As this Fed gets maybe a little bit more aggressive on interest rates and the long end of the curve begins to push back a little bit more. We saw this play out last year. Will we see a repeat later on this year? That's the price action in the bond market. This is what you can look forward to through the rest of this week. At 10 a.m. Eastern Time, President Donald Trump holding a news conference. Tomorrow, the big data point, inflation just around the corner. Plus, the current trade truce between the US and China is set to expire. Looking ahead to Thursday, PPI data and another round of jobless claims in focus. Friday, President Trump and Russian President Vladimir Putin meeting in Alaska. Plus, we'll get some retail sales data and UMich consumer sentiment numbers going into the weekend. Let's turn to trade. The Flexport CEO, Ryan Petersen, writing the following. US ports are bracing for a tariff-fueled surge. The new wave of reciprocal tariffs is driving last-minute shipping activity, especially from India, Taiwan, and semiconductor suppliers. I'm pleased to say that the man himself joins us now for more. Ryan, welcome to the programme, sir. Just describe, if you can, the activity that you've seen over the past few months. The rush to secure air freight, all kinds of things, Ryan. What are you seeing?
Yeah, hi, thanks for having me on. Wow, it's been crazy volatile ever since the Liberation Day tariffs were announced. You had immediately after that, you had a 60% decline in ocean freight bookings from China to the U.S. That lasted about 5 weeks, so just a massive decline of freight coming out of China. You then had, once the tariffs were relaxed, a surge to 80% above the pre-tariff level of volumes. That's what I was describing in that tweet. And now this, I think that was from a couple of weeks ago, because things have been settling in And now we're seeing the real effect of tariffs, which is people shipping less stuff. Prices of ocean freight are coming way down, back to, we're probably over the next few weeks going to see prices back to levels that we haven't seen since after the pandemic in like 2023 when prices were quite low. So I don't know if you call that normalizing or just like doing what you would predict, which is tariffs should lead to less freight, which should lead to lower prices. And it's not great for companies involved in the business.
Geographically, Ryan, what ports are dealing with really soft demand?
I assume that it's pretty evenly distributed across all the ports. I don't think there's a trend by port. It's actually one thing that has happened here is the airports, because when the tariffs are announced with such short deadlines, you see this huge rush to ship air freight in. And that sort of ended a couple of days ago at the end of last week when the new tariffs took effect. But in the prior 2 or 3 weeks to that, there was this huge switch from ocean freight to air freight. So I met one customer who said they saved $2 million by switching 4 containers from ocean freight to air freight just by beating the tariffs.
We've seen this administration really try to go after transshipment. How is that affecting the supply chains and what you're tracking?
Yeah, this new transshipment rule is quite interesting. So basically what they've said is that if you have one duty rate, which is around 20% for goods from, for example, Vietnam, but if the goods are determined to be transshipped from another country through Vietnam, then the duty rate is much higher. This is a very strange policy because historically, in all precedent of country of origin rules, then Vietnam has nothing to do with the duty rate. If they're transshipped through Vietnam, the duty rate is still China. China's duty rate is not Vietnam. So it's quite a confusing rule from those in the industry. What we're basically saying is, hey, in addition to going to jail for committing customs fraud, you're also going to have to pay a higher duty rate. So, I mean, I guess it's effective, but it's very strange policy.
But have you actually seen it work when you're tracking all of this cargo?
No, it's not. I mean, because it's a sort of a nonsense. It's basically saying, hey, if you're committing fraud, then you have to pay a higher duty rate. Well, the fraud, the penalties were already much worse for committing fraud than a higher duty rate. So no, we haven't seen anything change because of it.
Ryan, how creative are people getting? What kind of mitigation strategies are they introducing? What are you suggesting? What are you advocating for?
Yeah, I mean, the first thing I'm advocating is don't do anything illegal. And there's a lot of incentive to break the rules now because and you do see people who are breaking the rules. Now, for example, if you import goods from China and the Chinese company serves as the importer, and all you do is the American company that used to import them, and now you're just saying, hey, I buy them in America. The Chinese company imported them, and they happen to cheat on the customs duties. That's not my fault. Well, guess what? Customs will hold you liable. That's not a loophole that you can get out of so easily as that. What's legal and what we're advising people to do is look very closely at 3 things. 1 is the valuation of the goods. 2 is the country of origin. And 3 is the classification. Now, all of these seem like black and white, but they're not. This is the law. This is regulation. And therefore, there's a lot of room for expertise to come in and identify what is the gray area and what is the legal gray area. How do you stay on the right side of that legal area? And some of it's not gray. It's just sophisticated. So on valuation, if you provided CapEx assistance to your factory, or there's other rules that you can say how that lower the value of the goods, you would pay less tariff. You got to do it legally, though. Make sure you have an expert. On the country of origin, similar things. How do you classify this? How do you qualify this as being a country of origin that has a lower duty rate? There's a lot of sophistication in that as well, of saying, hey, did you apply enough new value added, either materials or labor in that other country to change the country of origin legally, not committing fraud? And the third is classification. It's illegal to change the classification of your goods in order to achieve a lower duty rate. But if the correct classification of your goods happens to have a lower duty rate, you win. So there's, again, a lot of work that needs to be done by sophisticated people who understand these rules that can help you out. Flexport has a team that does this, as do many other companies.
Ron, are you finding that more work just means more time? Is this slowing things down?
Yeah, it's definitely increasing costs for everybody in myriad ways. I mean, even just if you want to bring goods to another country, transform them, change their country of origin, and lower their duty rate, I mean, that's a lot of extra work, a lot of extra shipping time, labor processing. You've increased the cost plus the duties. So yeah, certainly this is not making trade more seamless. That's for sure.
Ryan, based on what you're seeing, is there anyone that thinks that the U.S. and China won't extend this deadline of their agreement, their truce, that's up tomorrow?
Yeah, I mean, I'm sure lots of people think they won't extend it, and some think they will. I haven't looked at what the prediction markets are saying on this. This administration is sort of inscrutable from my perspective. I don't really make a lot of predictions on that. So,
well, are people front loading and rushing before tomorrow from China, or no?
I mean, at this point, it's too late. So people were moving stuff in, but no, I didn't see a lot of front loading on the China one. Yeah, fair enough. From the behavior of the actual actors in the market, it seems like they think it'll get extended.
Ryan, appreciate your time and your insights. Super valuable. As always, sir, thank you. Ryan Petersen there, the Flexport CEO. It's just been this never-ending stimulus for global trade over the last several months. Get ahead of the next one. Get ahead of the next one, and then get ahead of the next one.
And it's constant. And what we saw on Friday was potentially this concern about gold bars. You can imagine some people getting very creative when it comes from gold bars, maybe in Switzerland or in Hong Kong, now having to play the duty. Well, maybe there's some way you can sneak them in, not sure.
Any reason to believe we won't get that 90-day extension in the next 24 hours?
At the moment, I don't have any reason to believe that unless Trump wants to use it as a negotiating tool to try to ramp up the heat and the rhetoric with China, especially as it goes into this meeting on Friday in Alaska with President Putin.
Trade in focus in the next 24 hours, that's for sure. The trade bump that we might see in goods inflation will be in focus tomorrow morning at 8:30 Eastern Time. At the moment, going into the opening bow, stocks doing okay, better than okay, at all-time highs on the S&P 500, around those levels, at those levels on the NASDAQ 100 going into the opening bow. Coming up tomorrow, we'll catch up with Keith Lerner of Truist, Torsten Slock of Apollo, Stuart Kaiser of Citi, Katie Kaminsky of Alpha Simplex to break down tomorrow's inflation data. Look forward to retail sales data later on in the week and maybe witness more all-time highs in this equity market. This market keeps on shrugging in the face of elevated policy risk down in Washington, D.C. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Day 4 at the Cincinnati Open. Coco Gauff lifted the trophy in Cincy 2 years ago on her way to the title at the US Open, and the American got off to a perfect start as she dispatched China's Wang Jingwu in straight sets. She moves on to face Ukraine's Diana Yastremska for a place in the 4th round. And don't forget, you can watch all the action live daily on Tennis Channel.